Bloomberg. Francine?
Danny, thanks so much. Now, as we await the Fed decision today, investors are taking stock of a rally that's seen the S&P 500 wipe out losses for 2020. Legendary hedge fund manager Paul Tudor Jones says it's confounded those who were doubtful about stocks.
If there was a franchise for humble pie, oh my Lord, there'd be a mile long to own that, because we've all had huge gulps of it, me included.
Well, joining us now is Kathleen Hughes, Global Head of Liquidity Solutions, Clients Business at Goldman Sachs Asset Management. Kathleen, thank you so much for joining. When you look at the Fed and what we can expect from the Fed, how did the jobs report on Friday change everything for where we're expecting the Fed to be in 2, 3, 6 months from now?
Yeah, good morning, and thank you, Francine. I think when we look at what we're expecting from the Fed today, it's not a lot of major policy changes. I think certainly we've had some uptick in consumer activity. We had a surprise, as you point out, in the jobs report on Friday, but we really think that they'll continue their dovish stance without any major policy announcements. I think we can point to the fact that they're very focused on the potential second wave of the virus. We're also still digesting what the economic impact of the virus is. So I think that's where the Fed is mainly focused. And we heard from Vice Chair Clarita recently that it would be a couple of months maybe or further down the road before they did announce changes. So our base case is we won't hear much. There's a small chance that they could give some guidance or some info on forward guidance or the reclassification of QE, but that's not our base case. We do think that will come in time.
When you look at what's going on around because of the pandemic and the lockdown and the economy, Kathleen, where do you see the biggest unknown? I know, partly it's because it's the virus in itself, but is there anything in the economy or the markets that clients ask you about?
Yeah, I think clients are focused on the same thing that we're all focused on, is what is the overall impact to the economy? And everyone is watching both unemployment numbers, we're watching virus and health numbers, we're watching, all of that play out. I think what we've seen in talking to clients on our corporate client side, it's really, how this impacts their own companies, their own balance sheets. What do they need to get through this? Certainly the actions of central banks from early on in the crisis has been focused on, bridging the gap, stabilizing the economy, and really focused on seeing us through this slowdown and this unprecedented economic slowdown. And, I think clients are focused on what we're all focused on.
And Kathleen, do you know if the money, do clients worry that the money that actually was promised by central banks didn't get to the right place? Or are they pretty confident in, the infrastructure that was used by central banks to get the money where it needed to be?
I think early days, there was that worry that it wasn't getting through that last mile to where it needed to get to. But I think what we're seeing now is that the mechanisms are in place. Certainly the unprecedented debt issuance, more than $1 trillion has been issued this year by corporates. And that has certainly made its way onto corporate balance sheets. That's been behind the huge run up in assets in global money market funds. So global money market funds are up $1.2 trillion year to date as of the end of May. So that corresponds very closely with the amount of debt issuance that we've seen. And if you think about it, CEOs were faced with the same uncertainty in terms of how their own companies would be impacted by the economic slowdown. So they did what they needed to do and shored up their balance sheets. And so that money is certainly sitting there and will be deployed and put to work as needed. So I think that is really a good example of money getting to where it needs to on the corporate side.
And Kathleen, when you look at corporate treasurers, I know you were saying, for example, that they've learned a lesson as a lot of us work from home or at least work remotely. How will that change, a lot of these corporate treasurers going forward and how they view risk?
Yeah, I think risk is something that is always top of mind for a corporate treasurer. We've seen it manifest itself in a couple of ways in conversations that we've been having since the start of the pandemic and the move to remote working. One clear way that it's come up in conversations has really been around technology and the desire to really make sure that they're relying on technology to reduce operational risk. So whether that is investing money, as corporate treasurers do every day. They invest money on their balance sheet, making sure that there's no risk involved in investing that money. As teams are working remotely, they're less able to maybe interact as closely as they might have been. They're also focused, as they rely on technology, on cybersecurity and the safety of that technology. And then just transparency that technology can give them. So I think technology is a way to reduce some of that operational risk and drive efficiency. And certainly that's come to the fore in terms of what corporates are focused on.
How much are corporates actually focused on, the world that we'll be left with post-pandemic? I don't know whether, this means different structures, working differently, but also selling differently.
Yeah, and Francine, that's a great question and one that we're spending a lot of time on. I think the whole topic of ESG has been front of mind for both investors and for corporates for a long time. Yourself, you spent time with lots of important CEOs and government officials at the World Economic Forum earlier this year, and ESG and sustainability was top of mind. And I think if we look back to that time, the focus was really on E and the environment and the supply chain and reducing carbon emissions and relying more on clean energy and renewable energy. I think since the
here on the ground in China?
Naturally, Tom, the members are quite concerned about U.S.-China relations. And so what we're trying to do is to remain the ballast in the relationship, where we try to keep the things commercial on track such that the two countries can then hopefully build from there.
Part of the ballast, it seems, is this phase one trade deal. We've been hearing from both US and Chinese officials saying they are committed to getting this phase one trade deal over the line and done. Those purchase commitments from China were always seen as pretty significant and maybe difficult to achieve. And now we've got this economic slowdown. Now we've got the impact of the virus. The Europeans telling us, the European Chambers of Commerce, that the phase one deal is essentially dead. Are they wrong? Is it possible to achieve this deal?
Yes, it is possible. I believe they are wrong. And I've heard the same rumors about the deal coming apart and such. But we have interaction with both U.S. government and China government that tell us differently. And so at this very time, 3 weeks ago, I sat at the Ministry of Finance with a senior official who's a member of China's negotiating team for the phase one deal. And we were talking about how our member companies could be a part of implementation for phase one. And so that process seemed quite sincere. It was also inconsistent with what we saw in some reports about the deal coming apart. And we've also since then seen purchases on the ag side and other things. That's not to say that things can improve. And indeed, COVID-19 is terrible in every respect, also as to the phase one trade deal. Things can improve. China can buy more agriculture. Currently, or at least as of a couple of days ago, there were about 130 oil and gas tankers on the water heading to China. I think 7 of them were American products. And so we would like to see more ag purchases. China can buy more airplanes, all those things that would really move the needle on the phase one trade deal. But in any event, again, I'm seeing sincerity in the process and both sides trying to get it done.
Greg, in terms of you put out a business sentiment survey, and I just wondered, beyond the trade tensions, what are the key concerns for your members as they kind of shape up and square up to the impacts of the virus and the slowdown in the economy? What are the number one things that are kind of holding back operations at the moment?
Overwhelmingly, our members are concerned about global travel disruptions. And so in our most recent survey, 90% of the members highlighted that as their number one concern. And that's up from 77% from the April survey. So we need American company executives back on the ground in China so that they can move forward with investment decisions and current investment plans. Not only do the executives need to come back, but they want their spouses and children with them, and they want essential support workers like nurses and doctors and educators so that their kids can actually go to school. China is working with us, and we're in close contact with central and local governments on this. And there is a fast-track process that they're trying to bring forward, and we're working with them very closely on that and relaying all that information to our membership. But again, our folks need to get.
And speaking of driving the business, Greg, David here, by the way, in Hong Kong, we were speaking with a market analyst yesterday, and her view as far
summer dresses and sandals for this month and July.
So what have they said of their strategic plans for the future? Will it change the way they operate?
Yes, it will. I mean, one of the other things that really helped them was that they'd been investing quite heavily in online over the last few years. And they've used this radio frequency technology, so they know where everything is. So they were also able to redeploy stock from stores to the online business, which limited the sales fall. And they want to take that further. They want to invest even more in online. And they also want to close between 1,000 and 1,200 smaller stores, mainly in brands outside of Zara, and absorb those instead into bigger flagships. Or transfer the sales online. So it's a shift, a slight shift away from physical stores to online, and that's very sensible because online, has been exploded during the pandemic, and it's going to carry on. So it's a wise strategic move to really try and capture that online growth.
Andrea, thanks so much for joining us. Andrea Felsted there from Bloomberg Opinion. Now, coming up, as the British Prime Minister is forced to do a U-turn on education, what else will he have to concede as he works to get the UK economy moving again? We'll discuss efforts to ease the lockdown in the UK, but also Germany. This is Bloomberg.
climate change is the defining issue of our time. So we've redefined how we cover it. With clear data and rigorous...
We had some numbers released on Tuesday that shows Chinese investment last year fell by more than 58% to 3.4 billion. So, yeah, the tension has been slowly building, but now we're really starting to see it erupt.
You look at where we are now with our testing results. On Sunday, we did 58,000 tests across the state. We're at 1.2% positive, the lowest level in the state since March 16th. That's a fact. Over the past few days, 58,000 tests we did on Sunday, 1.2% statewide. Saturday, 60,000 tests, 1.3%. Friday, 77,000 tests, 1.4. Thursday, 66,000 tests. Why are we reopening? Because these numbers say we can. It's no guess. There's no ideology. Based on the numbers, we can reopen. We are doing more tests than any state in the United States. We're doing more tests than any country on the globe per capita. That's why I have confidence saying to 19 million people, we can do this. Based on yesterday, 58,000 tests. That is a lot of tests. That is a large sample. And I feel confident making a decision on these numbers.
And obviously it's semantics in some ways, but it does matter in terms of sort of how investors think about the markets and what investors do in that market. So the relevance of saying this time it really was different. Walk us through your thinking.
Well, the bear market lasted from February 19th through March 23rd. So it only lasted 33 calendar days, and that was actually 23 trading days. And of those 23 trading days, during 7 of them, the market was down 20% or more. So it really was basically a 7-day bear market. I don't really believe that should be included in the record books as a bear market. It's really more like a panic attack. And I think the relevance is, if in fact it was a bear market, and that's the way you want to look at it, then I guess the question is, was this rally just a rally in a bear market? I don't think so. I think it was a continuation of the bull market that we had that started way back in March 2009.
What on earth is the justification for this, Ed? I mean, fundamentally, the economy is, just in a deeply bad state. The Atlanta GDP now figure improving, but still at minus 48% for GDP. And then when you look at earnings, we just had Bruce Richards talking about potentially year over year next quarter down 30%.
Sure. Well, you're right. I mean, from a fundamental perspective, you can say that it's a bear market because bear markets occur during recessions, and there certainly has been a recession. And as a matter of fact, the National Bureau of Economic Research just declared that the peak in the longest economic expansion of all times occurred in February. Some of the press has been picking it up, saying that the recession started in February. It actually started in March. But you know what? It may very well be over in May or June. I mean, in some ways, this is more a natural disaster than it is a classic recession caused by credit crunches and all sorts of other excesses that lead to a significant and long decline in the economy. This could very well be the shortest recession of all times. Basically, it would cover the second and the first quarter and the second quarter, but in terms of the monthly pattern, it really took a dive in March, and that was just the last 2 weeks of March. And then April, it took an even bigger dive. That's when we lost just about that's where all the negatives came in. But we're starting to see some indicators bottoming in May, and the outlook is that many of them will bottom in June.
We are seeing, Ed, obviously a kind of a rotation into the businesses that will lead us into the future. We're seeing the NASDAQ here breaking 10,000, that NASDAQ 100 right. for the first time in history. As a long-time watcher of these markets, I just want your kind of check on valuation here. In the context of, we had this sharp, issue we had to get past. We can even go back to January. What do you make of the value of these markets?
Well, very often you do get melt-ups in bull markets, and they usually occur near the tail end. But everything is sort of all over the place in terms of comparing what's going on now to the past. Let's just say that the bull market that started in 2009 is still intact. We may actually be seeing the melt-up phase in the market. I hope not, because if this thing becomes too much of a bubble, then we're going to have a whole nother problem within the next 6 to 12, 18 months. But valuation is not cheap. But it's hard to measure valuation off of actual earnings right now, because actual earnings are taking a dive. The market is clearly looking beyond the abyss right now, and the market is basically saying that for all the terrible things that have happened, the underlying earnings capacity of most companies has not been affected, that they are going to come back able to earn what they were earning back in late 2019 without that much duress.
I guess one of the questions that would upset that progress back to kind of where we were is indebtedness, especially on the consumer side, that would tip people over into bankruptcy, that this would be kind of the last straw, these few months interruption. You're not fearful of that?
Right. Well, I think there are going to be some aftershocks from what I call the great virus crisis, and the aftershocks will very much be in the areas of debt problems, because clearly there are going to be a lot of
to do that. But that raises difficult questions for the government, which is trying to balance between personal safety and getting the economy moving. Because if you're going to reopen shops, including non-essential shops, drive-in cinemas, and other things from as soon as next week, how can you have people working in those places when their kids are at home? So it's raising that dilemma of how you're going to allow the economy to start moving again in ways that the British government really wants it to, when the practical reality is that many people may not be able to return to work because they are looking after their children at home and teaching them at home. And so that's creating a dilemma for the government that they don't seem at this point to have an immediate solution to that.
Roz, we're also seeing protests in the UK after the death of George Floyd in the US. What challenges, of course, that raise for a government still trying to get the pandemic under control?
Well, that's right. You're seeing a government that's fighting multiple fires. The protests in the UK are not just about racial injustice in the US. They're about racial injustice in the UK, about a colonial past that some feel has not truly been acknowledged, and about inequalities today. You can see that in efforts to pull down those statues of historical figures now deemed controversial. And of course, the sense from COVID-19 is that people are already being left behind, that certain ethnicities are more vulnerable to the crisis. So it's another thing the government has to handle.
Thank you. Rosalind Matheson there.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
Jay Powell is unlikely to take comfort in May's payroll reports, staying dovish. Officials will publish their employment and growth targets for the first time since the pandemic. Negative rates would be fatal to the banking system. That's a message from Double Line's Jeffrey Gundlach. He says curve control will happen if the ascent of long-dated yields continues. And grim assessment, the OECD warns that the coronavirus pandemic is splintering the world economy and the most vulnerable will require extraordinary government actions. Secretary General Angel Gurria joins us shortly. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Tom, it's all about the Fed, and exactly what those employment forecasts will look like.
Yeah, so no question, the forecasts are really front and center. What's really interesting here to me, Francine, is it's the first real look here mid-year 2020 at the 2021 and 2022. It'll be fascinating to see how the different experts at the Fed set 2022 and what the chairman will say and what I assume will be a virtual press conference today.
Yeah, so we'll have, of course, plenty of market action. We'll look at the markets every 15 minutes, including what's happening in treasuries. Then we did have the OECD coming out with their economic outlook. That was released about an hour ago. And the OECD, basically, it's a smarter way of doing it, Tom. I haven't seen this before. So the OECD is forecasting that the pandemic will cause a global economic slump of 6% this year. But if there's a second wave, then that number becomes a 7.6% slump. So it's a good way of actually really visualizing what a second wave would do to the world economy.
Yeah.
We'll have plenty more on that throughout
It's
the
a
day.
really good It's a really good exercise. I was really taken aback, Francine, by the differentials between the bar charts of Europe and the United States. I really didn't have in my head how much worse the guesstimate is for GDP decline in Europe versus the US. It's a very good report.
Yeah, but it is also because of where Europe was in the economic cycle. We'll have plenty more on that. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, a warning from billionaire bond fund manager Jeffrey Gundlach. He says a 40-0 central bank policy may return if long-dated bond yields continue to rise. Gundlach's the chief investment officer at Double Line Capital. He says that Fed Chairman Jerome Powell may implement yield curve control if rates on Treasury securities drive much higher. Secretary of State Mike Pompeo is blasting HSBC for backing China's move to impose new security legislation in Hong Kong. Pompeo accused the London-based bank of what he called China's coercive bully tactics against the UK. He said Beijing uses HSBC's business in China as political leverage. The bank isn't commenting. President Trump is undermining Germany's Chancellor Angela Merkel, and it comes at a time when Merkel's facing growing pressure to get tough with Russia's Vladimir Putin. The president's decision to withdraw almost 10,000 troops from Germany was welcomed in Moscow. The US still hasn't officially notified Berlin of the withdrawal. The U.S. Navy is moving to ban public displays of the Confederate battle flag from its ships and bases. That's the military's latest response to growing calls to address racism. A spokesman says the ban is meant to uphold the Navy's core values. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. What an extraordinary day yesterday in the markets. Really, I think catching people unawares. Back to that momentum trade, that tech trade as well. And you see it this morning. I want to go through the equities here and the data carefully because I think it's something global Wall Street really cares about right now. The VIX is flat, 27.45. But futures are really, really interesting with the Dow futures negative 55, fractionally weak. S&P futures fractionally weak, and once again, NASDAQ futures, the NASDAQ 100 futures, the composite futures rather, green on the screen, which is really, really extraordinary to see that switch back yesterday. Of course, it's Fed Day. We'll look at bonds all through the morning and really particularly off of our special coverage at 2 p.m. And I really would note, Francine, we can talk about this through the show, but the currency dynamics this morning are extraordinary as the euro takes another run at 114.
Tom, stocks in Europe are advancing. U.S. equity futures, as you're saying, a bit of a mixed session. Investors are just waiting for the Fed. So dollar headed for a 3-month low against a basket of peers. But then I did want to show you also what's happening. Treasury yields, you also mentioned it, edging lower, and then crude oil actually retreating. So I'm really looking for, tomorrow, for example, Euro area finance ministers meeting to discuss the EU's recovery package, but also the presidency succession of the Eurogroup. Now, the OECD made a grim assessment in its quarterly outlook. The organization forecasts that the pandemic will cause a global economic slump of 6% this year, based on a scenario of the virus continuing to recede. A second wave, which the OECD said is an equally likely scenario, could mean a 7.6% contraction. Well, joining us now is Angel Gurria, OECD Secretary General. Thank you so much, Secretary General, for joining us right here on Bloomberg. First, when do we know if there is a second wave? Could this come in the next 12 months, or could we actually gain a bit of traction with the economy and then we need to go back and lock down?
Until we have a vaccine or a medicine, we are in danger. So obviously, the focus has to be on accelerating the research in order to get the medicine or the vaccine as soon as possible.
In the meantime, Angel Gurria, when you look at the economy, do you worry about deflationary pressures?
No, not the time to worry about inflation. Right now, you throw everything you got at the virus. You hit it, you kill it, you win the war against the virus. You throw everything in terms of finance, in terms of budget resources, in terms of health resources, because the sooner you beat the virus, the less expensive the recovery will be, and also you'll be able to cure the consequences of the virus itself in terms of unemployment and other sequels that it will leave us.
Angel Gurria, good morning from New York. I'm absolutely fascinated what Laurence Boone and others say at OECD about the amount of fiscal stimulus as compared to GDP. The variations are extraordinary. Who's getting fiscal stimulus right?
The question is that in many of these cases, what you call, government stimulus is, to a very great extent, guarantees or liquidity or loans, and therefore those will not become what I would call deficit numbers, or they will not become fiscal officially until there is some kind of payback, or in some cases the facilities are built to become deficit to the extent that, for example, the companies can maintain the employment. Those are meant to become, basically taken up by the government. But in many cases, in most of the cases, these large amounts, 20, 25%, 30% of the GDP, are meant to be paid back to the banks or to the development banks, and they're only guaranteed by the government. So the numbers are not comparable in that sense. If you take what I would call the hard expenditure measures, then that changes all over the place, from very little to very large.
Anhel Gurria, you are truly one of the experts in the world on your Mexico, on Latin America, and indeed the challenges of South America. The pandemic statistics from Mexico South are horrific, led by Chile, which is just simply falling apart. What does OECD think needs to be done to assist a greater South America in turning around this crisis?
Well, first of all, they need to be aware, and that means the leadership has to share these views. They have to act accordingly and within the constraints that they have. Within the constraints, this is very important, to then apply measures like confinement, social distancing, etc. The question, again, will not be solved until we have a medicine or we have a vaccine. But the problem in Latin America, Tom, and the problem in Africa, and the problem in Asia, is that it's very difficult to confine these people. They live in very close quarters, very close proximity. They have to go out every day in order to make a living. That makes it more difficult.
What does that mean, Anhel Gurria, about the prospect for emerging markets over the next 12 months?
It means because they're going to be hardest hit, and we always said this. The problem with this crisis is that, again, the most vulnerable are the hardest hit. And that includes the people, but that also includes the countries, the groups of society. And it means that their growth is going to be affected, and that also not only as much as the developed countries, OECD countries, but also that the impact will linger for longer. That is aggravated by one particular element, which is very high levels of informality. So even if you have the capacity to write the checks to all these people, you wouldn't even know where to send them, because half of the workforce are not registered anywhere. They're not paying taxes. They're not on the Social Security, etc. So that is a very, very great problem.
Anhel Gurria, when you look, I mean, we've never really seen a crisis like this, right? It's a health crisis that also turned into an economic crisis. So I guess it's finding the right balance between saving lives whilst at the same time reopening safely an economy. Who's getting it right? Who do you point to and say, you know, they have the right mix on how you do this?
Francine, the choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand, and you have to fight the pandemic first, as I said, with everything you got. You throw everything you got at it, and then that will allow you to beat that enemy first, and then that will allow you to pay a lesser price or lower price for the consequences of the pandemic itself, but also to set up the basis for a sound recovery going forward.
Anhel Gurria, thank you so much for joining us today, Secretary General of the OECD, with a really, really challenging and original forecast, folks. It's going to be amazing to see how the other greater institutions come out with their adjustments to economic growth as we go through this summer. Coming up, we've got much more for you. It is a Fed Day. Please stay with us through the day on economics, finance, investment, and of course, international relations. From London, from New York, good morning. This is Bloomberg.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
Bloomberg Surveillance. Good morning, everyone. Tom Keene in New York, Francine Lacroix in London, moving forward through the London morning. And then in New York, it will be most interesting to see how the day unfolds, particularly after the equity markets yesterday. And all this, of course, culminating in our Fed coverage at 2 p.m. this afternoon. Scarlett Fu leading our coverage with a lot of good voices. Really, really pleased at the mixture of voices that we'll have for you. Not so much about this meeting, but the mystery of how the Fed will proceed through the summer. Francine?
Tom, we'll have plenty more, of course, on the Fed policy, on some of the things that Jeffrey Gundlach was saying about negative rates. We'll also get analysis from guests in that show, including Guggenheim's Scott Minerd, former Minneapolis Fed President Gary Stern, the former Fed Vice Chair Alan Blinder, and Diane Swonk. So as Tom was saying, that Fed special starting at 2 p.m. Now, to talk about the Fed, to talk about negative rates, but also to talk about currencies in general, is George Saravelis. He's Deutsche Bank Global Head of FX Research. George, as always, thank you so much. And also, thank you for continuing to put those notes out that Tom and I really enjoy every time they come in our inbox. When you look at foreign exchange, I guess the one to watch out for today is dollar. What does Fed do today?
Well, there's a very wide range of outcomes, and I should say good morning, Francine and Tom first. It's great being on the show again. There is a very wide range of outcomes as far as the Fed goes. Our expectation is that they announce a QE program of $75 billion a month, but I think the risk around that expectation is that the entire package and decision is delayed until September, when they feel like they have a bit more clarity on the outlook. But structurally, I'm not sure the Fed decision is a big game changer for the dollar. We think there is more dollar weakness to go, and we will slowly transition from this first stage of the dollar move, which has been about the removal of the safe haven and risk premium, towards the second stage of dollar weakness, which will be the end of U.S. growth exceptionalism.
So if you look at your dollar, I know you've said also that the U.S. economic response, has been suboptimal to the pandemic. How much more weakness can we see in dollar by here until year end?
Well, we've been arguing the dollar can weaken by at least 10% from where it was a few weeks ago. So at the moment, it's moved, if you look at the trade-weighted dollar, it's moved about 3%. So that's suggestive of at least another 6% move. And I think it's very important to understand what's been going on in recent weeks. The dollar had a huge safe haven premium that built in March. But remember, at the same time, the Fed cut rates to zero and engaged in very, very large balance sheet expansion. So the reality is, if you take that risk premium away, the dollar should be much weaker compared to where it was in March. And on top of that, I think as we go into the second half of the year, the market will start differentiating a lot more economies based on growth outcomes. And we're very worried about the U.S. versus the rest of the world. We don't think the virus mitigation approach has been as successful as in other countries, which will weigh on growth. And we're also worried about the policy uncertainty premium that will build into the U.S. election. So quite a few pieces falling into place, I think, for dollar weakness.
George Saravelis, on euro strength is clearly non-linear as we move up through 109, 10, 113, beginning to test 114. Where does strong euro begin to impinge the European economy? Do you have a number on that?
I think you would have to start moving above 120 for the ECB to really start being concerned. At the moment, what you have seen is the move has been much more about a broader dollar move. So if you look at the euro trade weighted, it hasn't been appreciating as much. That's because other currencies have been strengthening against the dollar as well. But you do have the potential for more idiosyncratically positive euro moves. There was the recovery fund proposals have been a very big institutional leap for Europe. It's important those negotiations, the momentum around those negotiations is maintained. And I think if we were able to see a conclusion and the launch of this recovery fund as we go through the summer, on top of the very large backstop which Mrs. Lagarde has provided for Italy via the increase in pandemic QE, those are two important developments, a political backstop and a central bank backstop that can allow the euro to trade as the sum of its parts, while at the moment the market has been focused a lot more on its weaknesses. And the sum of parts for Europe, Tom, looks better than the US.
Yeah, very, very interesting. And of course, Mr. Saravellis dead on recent euro strength as well. We're going to continue with George Saravellis. I think this discussion on euro dollar is important. Don't forget at 2 p.m. today, Scarlett Fu leading our coverage on the Fed. I guess the Fed decides today. Maybe the Fed decides how to manage the message to the next meetings and into 2021. Please stay with us. Dollar weakness today. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolio.
This was a 3-hour webinar that we heard from a high-ranking official in Beijing, quite extensive in their explanation of this legislation. Your take, Professor? Did we get much clarity? This was a 3-hour webinar that we heard from a high-ranking official in Beijing.
Sports is where you bring people together. It's everybody's, it's an inclusive thing. But when we talk about our own personal battles outside of sports, there's a lot of people that are silent on issues, and they're important issues. They're issues that have been going on for hundreds of years, and we need that same type of team mentality to be brought to issues outside of our sport.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Good morning, everyone. Bloomberg Surveillance. Tom Keene in New York, Francine Lacroix in London. It is Fed Day, and we'll have complete coverage. We have a terrific lineup of guests for the Fed show. I'm particularly interested in speaking with a former vice chairman of the Federal Reserve System, Alan Blinder of Princeton University. His thoughts, really out of his classic Princeton course, on this fiscal impulse that we're seeing in America. Right now with us, George Saravelis. He writes shockingly acute notes for Deutsche Bank on foreign exchange and the litmus paper of the global system, the U.S. dollar. What's your unknown, George? It's got to be into this Fed meeting and into the summer, a great FX unknown for you. What is it?
Well, that's a very difficult question to answer, but I guess I'll start with the known unknowns, if you will, the questions we're seeking answers to. And I think that the first one, as it relates to the next few months, is how this virus will evolve in terms of second waves. I think there's going to be a critical difference with the first phase of the crisis, which, if you think about it, was global, it was universal. you had a shutdown everywhere in the world. But if I'm thinking about this debate on second waves, I think it will be very different. It will be more differentiated. You will see different countries responding in different ways. And we're worried that the US, when you compare it to some countries such as Germany or regions such as Scandinavia or Asia, is less prepared to manage that. And this concern is part of the driver of our weaker dollar view. The other unknown, known in a sense, is the outcome of the US election. And I think that will pick up as a focus for the market through the summer. The risk is you have all these large fiscal cliffs coming up over the next few weeks out of the US, whether it relates to the expiration of unemployment insurance or the PPP program. And the worry is the market starts building some risk premium and uncertainty premium into those events and the US election.
And what's fascinating here, George, is it's really a binomial distribution. You've got the outcome of the pandemic and the second wave and the nuances of that. And does that lead to dollar lassitude, or does it lead to renewed dollar volatility? Which would you guess it will be?
I think this second phase of the crisis, the management phase, if you will, is going to have a very different impact on the markets. The first wave was, in some sense, the speed and depth was unexpected. You had a massive flight to quality in the dollar. But the second wave, in some sense, is more predictable. We have already experienced what an epidemic curve looks like. So more predictable, people better prepared, but also much greater levels of country differentiation. So I think it could potentially eventually lead to higher volatility as well, but it's going to be a lot more concentrated in those asset classes, regions, and countries that are most vulnerable to being exposed to the shock. Latin America is one region we're concerned with, and in the developed markets, I would say Europe and Asia should be faring better than the US.
So how much, for example, in some of these emerging markets, and if we focus on the Brazilian real that's been going through quite a lot, George, will it all depend on the pandemic and what a second wave looks like?
I think what a second wave would look like is absolutely a very important driver of the market in the second half of the year. I would say also how it interacts with the other issue we discussed, which was the outcome of the US election. And this doesn't only relate to whether it's Trump or Biden that ends up in the White House, but also whether you have unified government or not, which in turn can have extremely different consequences for fiscal policy. Our baseline is that you still end up with divided government in the US, which restricts the capacity for continued large fiscal easing out of the US, in return leading to more US underperformance versus other countries.
George, what's your take on pound?
So I think the UK, unfortunately, is the weak link in Europe and the currency as well. You have seen sterling rally in recent weeks as the market has been taking out this risk premium on the dollar, but we're very concerned about the pound in the second half of the year. It's one of the currencies we're most negative on for a couple of reasons. One, the risk is the UK economy underperforms. The management of the virus crisis has been less efficient than in other countries. In addition, the composition of UK GDP is more geared towards sectors that would suffer from social distancing. And then beyond that, you have this new discussion around negative rates from the Bank of England. If negative rates go ahead, it would be transformational for the currency. This is a currency that is already suffering from twin deficits. If you combine it with negative rates, the risk is you see much larger capital outflows. And then finally, you have Brexit. So a very long list of headwinds, and I think the pound underperforms over the second half of the year.
George, thank you so much for all of the insight. George Saravelos there, Deutsche Bank Global Head of FX Research. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, Senate Republicans are drafting their own proposal for reforming police practices. It includes racial bias training, increased use of body cameras, and finally enacting the first federal anti-lynching law. House Democrats have already come out with their proposals. They want to make it easier to sue and prosecute police accused of wrongdoing. All of this comes in response to the killing of George Floyd in Minneapolis. U.S. authorities are investigating a vast hacker-for-hire scheme traced to India. It involves attempts to steal confidential communications from investigative journalists, short sellers, and advocacy groups fighting climate change. It's unclear who funded the hacking operations, but one of the beneficiaries apparently was the embattled German tech firm Wirecard. The company says it hasn't been in touch with any hacker group. The UK hasn't seen a time like this since the Industrial Revolution. Britain has gone a record 2 months without burning coal. Coal's portion of the power generation mix has dropped from 40% just 7 years ago to 2.5% in 2019. One of the big reasons, cheaper renewable fuels, nuclear and gas plants are meeting demand. And call it a sign of the times, the Paramount Network has cancelled the long-running TV program Cops. The reality show that glorified police work was entering its 33rd season. Cops ran on Fox for 25 years before the network dropped the program. Global news, 24 hours a day on air, and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
And Ritika, it may feel like 25 hours a day on Fed Day. We'll have our coverage at 2 p.m. Today, leading up to that, great conversations, and we're thrilled to bring you here in moments Jeffrey Curry of Goldman Sachs. We'll talk to Jeff Curry, of course, about this huge move in oil, what it means for Russia and for Saudi Arabia. Stay with us in London, in New York. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
morning, everyone. Bloomberg Surveillance, Francine Lacroix in London. I'm Tom Keene in New York. What we're trying to do is give you conversation here to set up what has been an extraordinary bull market, an extraordinary recovery in oil, and actually the moves in fixed income, quite interesting as well. With us now, Jeffrey Curry, head of commodities research for Goldman Sachs. We're thrilled he could be with us, and he's been very, very good on any number of topics. Jeff, I want to get this out of the way because I know there's a lot to talk about in oil, and that's really the reaffirmation of a gold call. We're here at 1,700. A lot of people are really on board the buy gold call. Is it, reaffirm that, is it still a buy gold call?
Yeah, absolutely. I think one thing that's interesting in the midst of all of this risk-on rally is that both real rates as well as gold have remained very stable. And particularly if we start to think about upward pressure on nominal rates, it'll likely be translated into lower real rates as your inflation break-evens begin to widen. That'll push gold higher. Also, when we think about what people are focused on is really tail risk inflation right now. Not that they think there's going to be inflation in the next, let's say, 12 months, but thinking about what does the outlook look like going forward, particularly with all the stimulus in the market. One negative on gold is the consumer demand in emerging market Asia. The numbers recently out of India were very weak. China's been slow to return to these markets. We think once you see that come back, this thing can easily go above 1,800.
With all the dynamics out there, including the dynamics in oil, what is the marginal central bank appetite to buy the next bar of Curry gold? I mean, what are the central banks going to do here?
Actually, the central banks have been absent. The emerging markets were the ones that were big buyers over the course of last year. You look at their finances right now, if anything, they have liquidity issues and are trying to raise cash. But they do it typically through the lease markets as they did back in April. In terms of our outlook going forward, we've taken out that strong demand from central banks, but it's being replaced strong investment demand, particularly from developed market consumers. They're the ones who are really pushing this, which is why if we get that emerging market consumer that's what's going to really take you up to the next leg.
Jeff, how much do you look at some of the other metals, or how much do you look at, for example, global iron ore market? I know that there were many mines that had to close down because of infections of COVID-19. Does that bring us to the brink? Is it on a knife edge because of the halting of some of these mines?
The metals are the star performer in all of the risk assets, whether if it's copper, iron ore, or capital goods more broadly. One of the key reasons is not only what you're talking about in terms of supply disruptions, but Chinese demand. You look at copper during the month of May, Chinese demand was up 29%. Let me repeat that, 29% year over year. We look at iron ore or steel demand, it's up somewhere around 7.5% year over year. Given the fact we're just going through this corona crisis right now, those numbers are astonishing. What's driving it is local government policy. They needed to raise finances, so they sold property, lessened or loosened the restrictions around consumer demand for property, and as a result, we have a very strong property construction and infrastructure market going on in China right now that is pushing these markets higher. But I want to go back to your point about supply. Yes, there's concerns about right now you don't have scrap because the world's not creating scrap. But second of all, you have the mine closures. Both of those are likely to reverse, particularly with Brazil being off right now. We think that's going to put downward pressure on iron ore at the end of this year, but not with copper. Our target on copper, 12 months out, 6,500.
I was going to say, so are you raising your target on copper, but also aluminium?
Yeah, with Ali there, it's much more of a macro dynamic. Most of these metals, one thing to keep in mind is they're very highly negatively correlated with the U.S. dollar. And the one thing with the dollar that we have seen is a normalization in demand after that very strong demand for U.S. dollars back in April and May. Because of that normalization, the dollar has traded off substantially. And that's been one of the biggest drivers of the rise in commodity prices recently. And when you look at metals in markets like aluminium, they're very much tied to movements in the dollar.
Let's come back with Jeff Curry. This is great. It sounds like the LME conference. We're talking to Jeff Curry here, metal. We have to talk to him about oil and particularly the renewed tensions between Saudi Arabia and Russia. So we're going to come back with Jeffrey Curry. Again, it is Fed Day. Scarlett Fu leads our coverage at 2 p.m. Stay with us through the day. This is Bloomberg.
Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg Business Flash. Deutsche Bank warns that provisions for bad loans will rise in the second quarter to the highest level in more than a decade. The German bank says the money is being set aside will reach about $908 million. Rising loan provisions are a threat to Deutsche Bank's restructuring plan. It's trying to restore profits after 5 years of losses. Morgan Stanley expects to make acquisitions in the asset management industry. CEO James Gorman told the firm's virtual financial conference he's not shy about doing deals that, quote, hit our sweet spot. There's been a rush to consolidate in the asset management business. That's due to pressure on fees from low-cost index funds and passive investing. Hundreds of thousands of tiny investors are flocking to stocks such as Hertz and Whiting Petroleum. The companies have two things in common. Both have filed for bankruptcy and each saw their shares double to start app. And that's the Bloomberg Business Flash. Tom, Francine?
Thanks so much, Ritika. Now, we were talking about metals. Now let's get back to Jeff Curry, Goldman Sachs Global Head of Commodities Research, and talk about oil. Jeff, we all followed with great interest what happened to OPEC Plus and finally an agreement for the extension cuts to actually be extended by a month. But how is oil demand going globally?
Well, when we look at the recovery, it's well underway, slightly above expectations, but it's not nearly as exuberant as you think by looking at the markets. In terms of looking at where are we right now globally, we're down relative to pre-crisis about metals out of China. The petroleum floor on that. So the dynamic has cooled off somewhat. One other last point on oil demand that's important is the commuting demand. People are afraid to take the subways or take public transport more broadly. So in places like Asia and Europe, we're seeing a surge in commuting demand. We're also even seeing it in the purchase of autos. You look at European auto demand, it surged before the dealers even opened. People are buying these cars over the internet. But the big one that you need to keep your eye on for losses is jet. I don't see that coming back anytime in the near future.
Will OPEC Plus have to do more in terms of extending the cuts again? What exactly is priced in the oil price right now?
Well, when we think about what they announced last week, I think it was very interesting and makes a lot of economic sense. They did the 1 month rollover and basically said they're going to be data dependent. This gives them two options. One, it tries to keep the prompt of the market really tight, which will create backwardation. They want backwardation. They want the forward prices below the spot so that the U.S. E&Ps don't sell forward. Second, it gives them the ability to retaliate or punish in the case of cheating. So the net of it, I think, is what it's telling you is that they're going to be watching the inventory data. They're going to be, watching that demand data, and it's just going to be really, month by month in terms of looking at how the rebalancing going. So the net of this is it doesn't mean they're just going to hold on for a month. It means they're going to reassess it after the end of 1 month.
Is there any evidence, Jeff Curry? Is there any evidence, Jeff Curry, that Saudi Arabia can control the cheating?
Well, I think by going to a 4-week, 1 month horizon, their ability to go, okay, we're going to reverse this really quick because you're not doing your part, a message to Iraq or one of those producers that are cheating is much more of a credible threat in the current environment than it has been in the past. But let's also be careful about, the fact that it's not in their interest to do these big structural cuts like they did back in 2016. I don't think they'll ever do it again. They did it once in 2016 and another time in the 1980s. Both times it ended in tears. And part of that reversal that we saw in March of this year was to really get away from, these long-term rebalancing views and take a much more, hey, this market's in a deficit, we add oil. This market is in a surplus, we take a little off and turn it into a short-term rebalancing mechanism as opposed to these long-term cuts that were very detrimental to the industry. So we like to point it cost, equity and bondholders $1.3 trillion, and it cost the OPEC countries $220 billion per year in lost revenue. So I don't see them going back to that old strategy again. They're going to be much more focused on, maintaining a balanced market near term and looking at market share going forward.
Okay, but it's $40 a barrel. Can they get away with that? I mean, my reading is they need a higher price. Is that right?
Yes and no, but I think in terms of looking at the social aspect of it, the answer is yes. But from a cost basis, the answer is no. And I think more importantly is at $40 plus a barrel, we start to create a drag on the rebalancing process. You've heard the news reports coming out of the U.S. oil patch. At these prices, they're willing to bring supply back onto the market. Our base case is that you need to keep prices around $35 a barrel right now to be able to maintain the rebalancing process that was already underway. Our concern here is prices go too much higher and they stay over. Commodities and oil are spot assets. They cannot price in expectations, and every time they try to price in expectations, it ends in tears. So we need to see prices get back down into those 30s again to really get this rebalancing process back underway.
Jeff, thank you so much. Jeff Curry there, Goldman Sachs, Global Head of Commodities Research. Now, the markets, of course, focusing on what we'll see from the Fed, the OECD's assessment also for global growth, or actually for a global hit, reminded investors that the risk from the pandemic is far from over. We also saw some U.S. employment numbers actually seeming to signal this recovery was underway in the U.S. That was last Friday, so it'll be interesting to see what Jay Powell does with those. I'm looking at treasuries, and you can see, Tom, that U.S. 10-year Treasury at 0.8 and European stocks down a touch, down 0.3%, Tom.
Francine, thanks so much. Again, it is Fed Day. We're going to drive forward the conversation. Lots of good guests set up now. Particularly, we've got a wonderful 2 o'clock for you led by Scarlett Fu, including Alan Blinder of the Fed. Next, Joseph Amato. He's with Neuberger Berman on the equity markets. Are you in those markets? Or like me, are you not? Mr. Amato will give at least me courage to maybe make that first investment in this stunning bull market that we are in. Futures mixed this morning, still some momentum, energy there versus value. Stay with us. This is Bloomberg. For Chairman Powell and the Fed, the trillions of dollars of early and often aid, they have stabilized America in the depths of the pandemic. What will the economy look like 6 months on the January 27th, 2021 meeting? Mission accomplished again. From JP Morgan, 77 to 117, to Hertz Rent-A-Car, 80 cents to $4.16. The Powell put, it has vanquished the bears. And the Secretary of State of the United States of America says the Hong Kong and Shanghai Banking Corporation has assisted the Chinese Communist Party in, quote, coercive bully tactics, that against the United Kingdom. Pompeo says it's a corporate kowtow. Good morning, everyone. This is Bloomberg Surveillance. I'm Tom Keene in New York, Francine Lacroix in London. It is Fed Day, and Francine, I have been guilty of not discussing enough what the Standard Chartered Bank and HSBC is doing, where they're saying they're going to, agree to or whatever with the new security rules of Hong Kong. How big a deal is this in your London?
Well, it was quite a big deal, Tom, when they announced, frankly, to the surprise of everyone. At the time, I think you and I spoke to Stephen Engel, and he reminded us that, it goes to show maybe the influence that Beijing has on some of these companies if they want to have licenses in mainland China. Now, this, again, is actually quite difficult to dig into the deep root of it, but certainly now we understand that there's a backlash from investors. So just, yesterday we had Aviva, one of the biggest investors in a lot of these banks,
yes.
For example, like Standard Chartered and HSBC, saying actually, look, it's uncomfortable with the decision of HSBC and Standard Chartered about, it's uncomfortable about the bank's decisions to back China's sweeping security rules planned for Hong Kong.
Absolutely fascinating what we see there. And of course, we've got lots of coverage through this hour and on through surveillance this morning. Raghuram Rajan will join us from the Booth School of Chicago in about 2 hours' time, the former leader of the Central Bank of India. Right now, with our first word news in New York City, here's Ritika Gupta.
Morning, Tom. Francine. The OECD warns that the global economy will slump 6% this year because of the coronavirus. And if there's a second wave, output could fall 7.6%. The OECD also warned governments that withdrawing support for businesses and workers now could make the economic and social damage even worse. Secretary of State Mike Pompeo is blasting HSBC for backing China's move to impose new security legislation in Hong Kong. Pompeo accused the London-based bank of what he called China's coercive bully tactics against the UK. He said Beijing uses HSBC's business in China as political leverage. The bank isn't commenting. President Trump is undermining Germany's Chancellor Angela Merkel, and it comes at a time when Merkel's facing growing pressure to get tough with Russia's Vladimir Putin. The president's decision to withdraw almost 10,000 troops from Germany was welcomed in Moscow. The US still hasn't officially notified Berlin of the withdrawal. And the U.S. Navy is moving to ban public displays of the Confederate battle flag from its ships and bases. That's the military's latest response to growing calls to address racism. A spokesman says the ban is meant to uphold the Navy's core values. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. On equities, bonds, currencies, commodities, red and green in the equity markets with a little bit of flatness there, a little bit of weakness in Standard & Poor's 500. NASDAQ futures up. There's no other way to put it. And of course, some of that guesstimates forward on what Apple will be doing for the rest of the year. I know that's part of the NASDAQ mix right now. In the bond market, there's no question yields come in, and they've come in quite nicely from 0.92% on the 10-year over the last couple of days. We breached below 0.80%. What a good conversation, Francine, with George Saravellos about foreign exchanges, reaffirmation of stronger euro and a decidedly weaker dollar.
Yeah, he was also very good on pound. This is what I'm looking at for markets. So stocks are slipping again. The OECD about 2 hours ago gave a warning on the economy, and it seems to just maybe have shaken the memory of the markets on the fact that, look, this disease is not over yet. The pandemic is not over yet. And then you look at dollar holding a 3-month low against a basket of peers. Treasury yields edging lower, crude oil retreating down.
Very good. It is an extraordinary day, and of course we'll be very much focused on economics here towards the Fed meeting, but still there is an America transfixed by this moment. You see it with cultural announcements on Gone with the Wind and the Fox television network show Cops, and you see it also in each and every community and each and every debate. And with this, there are symbols. Joining us now, our chief Washington correspondent, Kevin Cirilli. Kevin, the ultimate symbol of the moment is the set of fences wrapped around President Trump's White House. When does the North Lafayette Park fence near the church, near the Hay Adams, when does that fence either be moved or come down?
Well, the city came out and said that just sometime within the next week, actually, they're going to reopen Lafayette Square Park, which, of course, has now been the site of a historic illustration and symbol, as you recall, within the past week. But beyond this, in terms of where the conversation is moving, there is now a Senate policing reform bill in the upper chamber, of course, put out, of course, controlled by Senate Majority Leader Mitch McConnell. And yesterday, Mark Meadows, he's the president's chief of staff. He was up on Capitol Hill with Jared Kushner and some other of the top advisors to the president, meeting with Senator Tim Scott, a Republican from South Carolina, who also is African-American, the only African-American senator Republican, and they are now looking at policing reforms. So this is definitely something that Republicans are now working on. This is House Democrats have also come out with proposals of their own.
Right. But do we know what the president is working on? I reviewed the many tweets, and I don't detect a plan. I understand the senator, Mr. Scott. I understand the political pressures, but for those for and against the president, is there any demonstrable plan from President Trump?
Well, I think there's two areas of agreement between Republicans and Democrats on this issue. One is the potential to remove the chokehold as a mechanism for law enforcement to utilize. And second is to look into the past actions and comments of police officers, particularly those who have a history of making racist remarks. That is something there could be consensus on. Also, this idea of better police training, I think, as well. Beyond that, for the president is not going to say he wants to defund police. Even Joe Biden has said he doesn't want to defund police. But I was struck by some of the polls that came out, not top-line national polls, crosstabs, because Americans, the majority of Americans, Republicans and Democrats, are just wanting there to be a period of calm. They want a sense of normalcy. And the unrest that has percolated throughout the country over the last several weeks is something that the administration feels has hurt them at a national polling level. So, you know, I think the president now, from a political standpoint, is facing the pressure of poor polls against Biden and these crosstabs, which are suggesting that people want a return to normalcy.
Right.
Kevin, how will the president use the economy? So, you know, the fact that the U.S. is now officially in a recession may make it problematic, but we also had some pretty good figures on Friday from employment. Right. So how will the president use that?
You know, Francine, this is where it gets interesting, is because the national polls and the battleground polls have the advantage to Biden. But if you look at the crosstabs, Trump is still beating Biden on who's better to handle the economy. So to that point, that's their glimmer of hope. That's where Republicans are seizing on. That's where the re-election is seizing on. When I talk to the sources on the re-election campaign, that's what they tell me. So this drumbeat of good and positive reopening economic indicators, they're going to use as a setup to say, hey, let's draw the contrast. We want to reopen the economy. Democrats want to keep it shut down. So that's where the debate is moving, but it's all dependent upon the economy moving in the right direction.
Thank you so much, our Kevin Surley there, Bloomberg's chief Washington correspondent. Now, coming up shortly, Joseph Amado, Neuberger Berman president and chief investment officer of equities. We'll talk about some of the valuations out there. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. On our Fed special today, good conversation, good analysis of what we'll see out of Chairman Powell. Scott Meinert will be with us. Scott Meinert, of course, has been extremely cautious on the markets. It'll be good to hear what he thinks of this bull market, running away from his caution. Gary Stern will be with us. He is, in my estimation, by far and away the most underrated of the former Fed presidents. He is really sharp. Really looking forward to speaking to Dr. Stern. Alan Blinder with us, and Diane Swank as well. And Diane Swank with that pulse on the Midwest economy at Grant Thornton will be a timely conversation as well. Joseph Amado is at Neuberger Berman. Neuberger Berman is a really interesting shop in New York. Yes, they manage money, but they've got a certain panache to it, a certain style. If you work long enough at Neuberger Berman, maybe you'll be in a hit movie. We're still waiting for Joseph Amado's hit movie. It's out there somewhere. He drives forward equity coverage for Neuberger Berman. The chart comes out every day in Zero Hedge at 4 p.m., Joe Amato, and it's comparing the momentum stocks to pretty much everything else. Momentum in value. Who's going to win out going forward? Does momentum keep momenting, or does value catch up?
Good morning, Tom and Francine. Good to be with you this morning. It has certainly been a pretty amazing contrast over the course of the last number of months and disparity and dispersion between quality growth and momentum versus cyclicals. And so far, at least, since this crisis has occurred, quality and momentum have won out in a huge way, reflected in, look at where NASDAQ is. It's extraordinary that NASDAQ's up double digits so far this year in light of the kind of economic damage that we've had. It's pretty extraordinary. And when you look at things like Russell 2000 value, it's still down 15 to 20%. So that disparity is still quite significant. We're seeing some of our teams rotate out of some of those quality momentum names into, I would describe it as maybe quality cyclicals. And I think as the economy recovers, high-quality cyclicals, whether they be in the financial space, the industrial space, or others, I think are in for a better run here over the near term as the economy starts that recovery process that people have gotten so excited about in the last couple of weeks.
Joe Amato, Gino Martin Adams in equities for Bloomberg Intelligence is really quite adamant that there's a misestimation of how earnings will recover, that it's just not priced in. Is the market pricing in earnings recovery, or are they moving up the income statement and pricing in the shock of a revenue recovery?
Well, I think the markets are certainly expecting that 2021, you're going to see a strong earnings recovery. And certainly in that segment that you referenced earlier, the larger quality names who've had more durability through these challenging period are going to see better earnings recovery. 2020 is essentially a write-off for most. I don't think anyone cares that much about where 2020 ends up. It's more what the run rate is as you move into 2021. In those larger quality names, I think that could be high, and that's reflected in where valuations are today. Whereas at the same time, as you move down the cap structure, cap size, so mid and smaller cap, and certainly in the cyclical world, I think there's still lots of skepticism that 2021 earnings will be anywhere near 2019. And that's, I think, right now the debate in the market, which is right now, I think people may be confusing the speed of the reopening with the strength of the recovery, and I think we're focusing on trying to assess the strength of that recovery and when you'll be able to recapture whether it's economic activity, so GDP dollars of 2019. When do you get back to that level, or the earnings levels of whether it be the S&P 500 or other indices?
Well, Joseph, good morning from London. Is there an assumption in the markets or an earnings forecast that actually the pandemic is over?
I don't think anyone is assuming the pandemic is over. I think there is definitely a legitimate concern about a second wave, and I think the debate about a second wave is whether it creates more shutdown or whether it's isolated clusters that reduce certain levels of economic activity but don't have the comprehensive level of shutdown that we saw back in March and April. So I think most of the science experts expect some level of a second wave. Historically, viruses like this tend to have second waves. So, our underlying assumptions is that there is going to be some level of that, but not to the extent that, of course, we saw back in March, April, and not having the corresponding impact on economic activity. But it may affect the speed of that reopening and recovery, and that's one of the things that I think everyone's worried about.
Great. Thanks so much. Joseph Amato there of Neuberger Berman stays with us. Now, we'll also have special coverage of the Fed's rate decision and Chair Powell's news conference. That begins at 2 p.m. in New York, 7 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we're talking about market valuations. Let's now get back to Joseph Amato of Neuberger Berman. Joseph, I look at all the protests in the U.S., but also in London and elsewhere, asking for more justice and less inequality, especially when it comes to diversity. Will it change the markets and the way investors choose a company they want to be invested in? Are we going to have more indices on diversity, and will it actually change the value of a company because of it?
Well, I do think that the health crisis and economic crisis that we've gone through has really exposed some real challenges and fault lines, if you will, in certainly the U.S. and a number of other economies. When you see the inequalities as it relates to income, educational opportunities, healthcare access, criminal justice, these things have been shown to be, even more of a problem as they were before. And I think as it relates to investors, we've talked a lot over the number of years around ESG, environmental, social, and governance investing, sustainable investing. We have had strategies related to that type of investing for decades now, and I think that's going to be an even a deeper dialogue with clients as they think about the sustainability of companies that they invest in, and push companies hard to understand how they're treating their labor force, how they're dealing with some of the issues that we've talked about. So I think it is going to change. It is going to highlight and focus that much more on sustainability and ESG. Many investors in the past have felt that that's a bit of a theoretical discussion, when now you see the reality of it, and I think it's really going to regain focus.
Do we have the right data for you and companies to actually make the right amount of decisions? Do we have the right data and transparency to understanding what each company does?
It's a huge issue. We've been big supporters of increased disclosure. A lot of proxy questions have come up in this proxy season around increased disclosure as it relates to environmental issues, as it relates to the nature of a company's labor force. And the more we can get on an equal footing, so we've been supporters of sustainability accounting standards that have been pushed forth, that as you look across companies, you can more in a deeper way understand and determine relative value and how these factors are affecting the company. And ultimately, our focus is on the material factors that do affect companies' performance and help you manage risk as an investment team.
Joe Amato, is Neuberger Berman investing around a theme of there must be consolidation for whatever reason, including all these new social stresses? Do you just assume a consolidation of the American corporation?
I don't think, Tom, that's been an underlying issue driving a lot of investment activity. Certainly there are different forces affecting different segments of the economy, whether you see more consolidation in the financial services sector or among smaller mid-sized banks, or whether you see that in other elements of the economy. And certainly when you go through the economic stresses, there are going to be those companies that are going to struggle to survive. One of the both challenges and opportunities of what the Fed has done it's allowed, frankly, weak companies to survive by providing capital and coming in and essentially keeping the capital markets open, whether it be for quality companies or companies that are struggling more. So that may mitigate some of the consolidation that you typically would see in the sort of the typical destructive process that economies go through when they grow and they contract.
Joseph, thanks so much. Joseph Amato there of Neuberger Berman. Now, coming up, Bank of Italy Governor Ignazio Visco joins us for an exclusive virtual conversation on the outlook for the Italian economy after the COVID-19 crisis and the response of the European Central Bank to the pandemic. That interview coming up 2 p.m. in London. That's 9 a.m. in New York. And this is Bloomberg.
shall we? So the euro on a 7-day winning
Sizable moves in the currency market. Temperatures down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange rate.
China's slumping onshore bond market is great.
Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg First Word News. Senate Republicans are drafting their own proposal for reforming police practices. It includes racial bias training, increased use of body cameras, and finally enacting the first federal anti-lynching law. House Democrats have already come out with their proposals. They want to make it easier to sue and prosecute police accused of wrongdoing. All of this comes in response to the killing of George Floyd in Minneapolis. U.S. authorities are investigating a vast hacker-for-hire scheme traced to India. It involves attempts to steal confidential communications from investigative journalists, short sellers, and advocacy groups fighting climate change. It's unclear who founded the hacking operations. But one of the beneficiaries apparently was the embattled German tech firm Wirecard. The company says it hasn't been in touch with any hacker group. The UK hasn't seen a time like this since the Industrial Revolution. Britain has gone a record 2 months without burning coal. Coal's portion of the power generation mix has dropped from 40% just 7 years ago to 2.5% in 2019. One of the big reasons, cheaper renewable fuels, nuclear and gas plants are meeting demand. And call it a sign of 33rd season. Cops ran on Fox for 25 years before the network dropped the program. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Francine, Tom.
Rudika, thanks so much. Now, efforts to combat the spread of coronavirus cases continue to vary across the U.S. Roman Friedman in Project Syndicate writes the market, left to its own devices, does not produce a sufficient quantity of personal protective equipment, ventilators, and therapeutic drugs, nor, if and when the time comes, will it ensure universal vaccination. While capitalizing on America's private sector dynamism will require the state to create incentives to produce such social goals. Well, Roman Friedman now joins us. He's a Project Syndicate founding editor and NYU professor. Professor Friedman, when you look at what we've been through and what will happen in the future, will this have to create a new social contract? Mr. Friedman, I don't know if you can still hear us, but will this create a new social contract between what citizens expect of their government?
I would definitely hope so. And what I would hope will happen is that there will be no pressure for erratic government action, excessive spending, but there will be more understanding that what we need is an active state that actually delivers social goods that the market simply is unable to deliver. And this is not a very difficult point to understand. Use masks.
This was a 3-hour webinar that we heard from a This was a 3-hour webinar that we heard from a high-ranking
tell you is that you need to ensure against the worst outcome. That's the development of the theory.
Roman, let's do this. Let me come back. We're going to go to break here, Professor Friedman, and then we'll come back. And I really want to drive forward your original policy prescriptions. With us from New York University, Roman Friedman, and we will continue. This is Bloomberg. Good morning.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London, Tom Keene in New York. Of course, the Fed Day. We'll do that with Alan Blinder, among others, joining us at 2 p.m. And right now, this is a special treat. It's academic, but nevertheless profoundly important. Kenneth Rogoff and Edmund Phelps make clear all in economics must listen to Roman Friedman of New York University, hugely controversial over the years on what policy should be out of our economics. Professor Friedman, we speak to you now in an imperfect American labor economy. We are in a job depression. You and the laureate Ned Phelps have led with talking about this strange word, dynamism. We need a dynamic America. How do we get there, Professor Friedman?
We get there by activating, by incentivizing, by understanding two things. The state cannot produce, we need to rely on the private sector. But yet, the private sector will not deliver the social goods that we now need to recover from the COVID, to deal with climate, and to actually have jobs that are durable and meaningful. The way to do that is to have the state being active in specific areas in which we need to incentivize the private sector, so the private sector will actually deliver. So we've had that in the United States. The internet to some extent was that, but we need to basically reset, not just the response against the pandemic, but we need to reset the relationship between the private sector and the state. Understanding that the world is imperfect means that the state cannot produce by itself, but that does not mean that the state could not play an active role in incentivizing the private sector. We've seen that very successfully done across the world. It requires two things. It requires clear objectives and requires clear incentives and mobilization on the part of the state. Take New Zealand, among many. The strategy of the government from the very beginning was health first, economy second. The focus on that produced a very rapid response to the health crisis. New Zealand now has had 0 cases and therefore no economic fallout that we've experienced. Take cases that are maybe not as illustrious, but illustrate the point. Take Germany. The government realized that mobilizing the private sector is crucial. The total package was actually more than $2 trillion we spent on supposed stimulus. It was precisely on the kind of policies that I've been advocating. The result is that they're really reopening now safely, and the numbers speak just for themselves. What do we have here? Sure.
Mr. Friedman, thank you so much. A great story, of course, in Project Syndicate, and I urge everyone to go and read Roman Friedman's piece. Now, coming up, a genetic testing firm 23andMe has found that certain blood types are less susceptible to contracting the coronavirus. Findings from a survey of hundreds of thousands suggest that the O type is especially resilient. Now, the company's chief executive told us that change the results may bring about.
Our customers really rose to the challenge and they contributed to this research. So 750,000 customers took this survey. We have over 12,000 people who said that they had COVID-19. 2,000 of them said that they were hospitalized. So we were able to analyze this data. We found that the O blood type actually looks like it's protective. It's not a huge increase in protectivity, but it's 9 to 18% less likely to be infected and be severe. So it's an important step. And I want to emphasize, there's more research to be found here, which is part of the reason why we're still enrolling people in this study. We are offered, we're giving away 10,000 kits for anybody who has been hospitalized, who had COVID-19, in part because I really believe we have the potential to find, genetic associations that will help us know who's the most vulnerable, and then can we do more to potentially protect those people.
So it's obviously good news if you're type O, and I know it is very early, but have you found any clues, showcasing any trends for other blood types? I mean, anything preliminary?
It looks like the other blood types, again, O looks like you have a decreased risk, and the others all look relatively similar. So the important thing with biology and science is first trying to understand why is it that O looks like it's potentially protective in some ways, or you have less of a risk. So understanding that biology, and then will that help translate into, a genetic test that would help be able to identify people to say, hey, you should really be more protective, or help in vaccine discovery or in drug discovery in any way.
Now, what's so interesting about COVID is that it can spread so fast undetected, which means some people get very sick and many people don't get sick at all. And the question of the hour is why? Genes, and your research indicates that genes can very much play a role here. Are there any other clues about the role that your own genetics can play?
That's exactly what we're looking for, and looking to see, the asymptomatics would be really interesting. And that's why we're giving away kits, because those people are so hard to find. So we're saying anyone whether they're a customer or not, can participate in this kind of research. And I just want to add, a lot of infectious diseases, so things like norovirus, which is known as the cruise ship virus, there are genetic mutations that say these individuals are significantly less likely to get the disease. Even things like HIV, there's mutations that say people are significantly less likely to be infected with HIV who have this mutation. So we're looking for that kind of mutation that would help people understand whether or not they're potentially, significantly less at risk for getting infected.
Now, most of the studies so far have had a few thousand participants. Your study involved hundreds of thousands of participants, and still there's more work to do. So how do you go from a hunch to actionable information?
I think like I said, I'm really proud of my customers really, again, stepped up and rallied, and the hundreds of thousands, 750,000 people took this survey, and it shows the power of actually having a community like 23andMe. But at the same time, one thing I do need is more customers who have been hospitalized. So there's a period of time, we need to make more discoveries. The scientific community needs to vet it. They need to understand the biology around it. And I think over time, this will absolutely start to get integrated into how we're managing COVID-19.
Well, that was 23andMe Chief Executive Anne Wojcicki. Now, coming up, Lauren Sauer, Johns Hopkins University Assistant Professor of Emergency Medicine. We'll talk about the pandemic. We'll talk about COVID-19. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. Deutsche Bank warns that provisions for bad loans will rise in the second quarter to the highest level in more than a decade. The German bank says the money being set aside will reach about $908 million. Rising loan provisions are a threat to Deutsche Bank's restructuring plan. It's trying to restore profits after 5 years of losses. And Morgan Stanley expects to make acquisitions in the asset management industry. CEO James Gorman told the firm's virtual financial conference he's not shy about doing deals that, quote, hit our sweet spot. There's been a rush to consolidate in the asset management business. That's due to pressure on fees from low-cost index funds and passive investing. Hundreds of thousands of tiny investors are flocking to stocks such as Hertz and Whiting Petroleum. The companies have two things in common. Both have filed for bankruptcy and each saw their shares double to start the week. Chapter 11 filings have apparently become buy signals for day traders. Many of these investors are buying the shares through the Robinhood app. And that's the Bloomberg Business Flash. Francine?
Rudiger, thank you so much. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we're bringing you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now to discuss all of this is Lauren Sauer, Johns Hopkins University Assistant Professor of Emergency Medicine. Professor Sauer, thank you for joining us. The World Health Organization seems to be going backwards and forwards about comments on how this virus gets spread by people who are asymptomatic. What do we know about how readily the virus is actually spread by people who don't have any symptoms?
I think we have a lot to learn on how actual asymptomatic transmission occurs. There are several studies looking at asymptomatic transmission rate, and I think one of the challenges is understanding when we're talking about asymptomatic versus pre-symptomatic. And much of what we know right now about the virus and how it spreads, how it transmits, is really based on the transmission around people who have symptoms, whether they're mild or severe.
What do we know about genetics? We were also hearing earlier that if you have a blood type O, there's a lesser chance of you developing the virus into something that is worrying.
Yeah, so the 23andMe study that found that blood type O people were less susceptible to severity of illness, that was a study of about 10,000 participants, and what it really showed is we have a lot more to learn again about how host genetics, host genomics impact how people are susceptible to COVID-19. So there was a study that looked at host genetics or human genetics and its impact on people with COVID-19 in China, and one in Italy and Spain, and they found the Italy and Spain one found that type A was created a likelihood of increase of severity, and the Chinese study also looked at susceptibility to COVID-19. And this 23andMe one, I believe, is the biggest study that has been done, and I think it's the only one that's looked purely at an observational study about blood type. And I think, you know, this is how we're going to start to learn so much more about this disease, because it's reaching people who have never been hospitalized, have never sought care, and those are the ways we're going to learn more broadly about COVID-19 across the population.
We talk about, you know, the study made in China, the one in Italy. We talk about 23andMe. Is there an overall study that actually gathers all individual studies so that we actually put all the data together, or is that just clinically impossible?
Yeah, so those types of studies generally are called meta-analyses, and what they do is they find the papers that have rigorous and similar methods, and so you have to go through each paper individually, understand their methods, understand their results, understand the underlying data and the assumptions that they made in their calculations, and then you combine those papers together. And so as more of these papers come out, people will be able to do meta-analyses of these papers to have a broader understanding, a more population-wide understanding. There's challenges associated with meta-analyses, and there's only so many things you can actually analyze, but they can be really, really powerful.
Where are we seeing spikes at the moment, and how do you track a possible second wave? Is it by, is it just the number of infected and by contact tracing, or by the people that end up in hospital, or is there a better way to try and see it before it actually arrives?
So testing continues to be the best way. Contact tracing can be really helpful once you have an understanding of where the transmission links are occurring in communities. You need testing as a backbone of contact tracing, because you have to understand, especially in that place where we were talking about earlier with those pre-symptomatic cases, you want to catch people as soon as they develop disease, and then you want to understand who their contacts are and use quarantine or isolation to limit them as much as possible. We're seeing spikes in over a dozen states probably since about Memorial Day, and so there's cases across the country that are having increases, and some cases in some states even. Yes, sorry.
Thank you so much. We have to leave it there.
Thing.
Lauren Sauer there of Johns Hopkins. This is Bloomberg.
los que hayamos adoptado un abuelito, vamos a continuar viéndolos a nuestros abuelitos, ¿no? No podemos dejarlos de verlos. Por el hecho que se termine de solucionar la pandemia, más bien al contrario, habremos tenido un mayor contacto con nuestros abuelitos hasta sus últimos días.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
To imagine that we'd see a quick V-shaped recovery. I think it's going to be slow.
I think the data that we have in hand on the economic front do suggest a cyclical upturn in the third quarter.
Central banks, they did what they had to do, which is they're not trying to make life nice for the government.
The choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures just about turning positive. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro together with Lisa Abramowitz, and Tom Keene just several hours away trying to get our hands around the next phase of monetary policy at the Federal Reserve.
Now, no question about that. What we talked about yesterday, John, what's so fascinating here was Scarlett Fu leading our coverage at 2 p.m. this afternoon is getting out to 2021 and even trying to have our central bank measure 2022. It'll be great to speak to Raghu Rajan of the Booth School, Chicago on that in a bit.
Looking forward to that conversation in a couple of hours' time right here on Bloomberg Surveillance. Tom Keene, we've also got to talk about the projections. We have not had projections from the Federal Reserve since December of last year. And those projections, compared to what we're about to get a little bit later today, they were looking for 3.5% unemployment in 2020 and GDP growth in and around 2%. Nobody saw the revisions that would have to be made just half a year later.
No, absolutely extraordinary. And then you see it within the economic data, John, that we've been talking about. And as you know, Olivier Blanchard mentioned in our show open there, the challenges forward on policy buttressed up with, again, John, I know you were long Amazon and long Apple yesterday, driving forward the NASDAQ market.
I wish I was, Tom. I wish I was, not just yesterday, but through the year as well. Tremendous performance in this equity market. Who would have thought that we'd have the revisions we're about to get a little bit later, and this equity market would be higher now versus where it was in December when we had the rosy forecast from the Federal Reserve. Speaking of the data, 90 minutes away, a little bit more data in America, Lisa.
Yeah, and this is the real focus for policymakers, both in the monetary as well as fiscal side, and that is deflation or disinflation. We certainly saw that out of Europe. And today at 8:30 a.m., we're going to be getting consumer price index data. I'm curious about whether we're getting the right kind of inflation. In other words, the necessities are going up in price. The food you buy, the homes you rent and buy. Is this the right kind of inflation? But just dialing ahead, the other things I'm looking at today at 2 p.m., yes, we're getting the FOMC statement, but before that, we're also getting the monthly budget statement from the United States. So we'll take a look at the deficit. And then the key event of the day, John, the FOMC meeting. I'm very curious to see what they have to say about yield curve control and how much of the Treasury market the Federal Reserve will end up having to buy in order to peg the longer term bond yields as many people are expecting.
Will they give us a monthly rate? Tom, what does the forward guidance look like? And I imagine the dot plot is in play as well. How much does that long-term dot come down from where it was at the turn of the year? I imagine quite considerably lower than where we were several months ago.
And you look at the dot plots, John, come on. I mean, I've never been a big fan of the dot plots. You know, Bullard used to put that one down below just to show his protest as well. I think one of the key questions, John, over the next 1, 2, and 3 years is when does the dot plot disappear?
Well, let's be clear. The whole market, the whole world came down to the Bullard dot eventually, didn't it? Several years later, we got there. We got there eventually. Let's start the program this morning with Priya Misra of TD Securities on this Federal Reserve decision several hours away. Priya, let's just begin with what you're focused on and what you want to hear from that news conference with Chairman Powell.
Sure. So, I think we're not looking for any specific policy action. We're not looking for them to strengthen forward guidance. We're not looking for a specific dollar amount that they're going to be buying per month. I think what I'll be focused on is the language. How does Chair Powell frame the outlook, frame the reopening? We had a pretty positive payroll number, but in our view, on Friday, but in our view, that was expected. When the economy reopens, you are likely to see much better data. But I think for Chair Powell to stress on the medium-term risk, I think one of the things we're really focused on is, yes, we're reopening slowly, but are we reopening to a new normal? And we just don't know this. So I think for Chair Powell to say and for the Fed to say there's considerable risks in the medium term, we're going to remain highly accommodative and sort of suggest that there might be more steps in the months ahead. So I think we do expect them to undertake yield curve control. We expect them to be buying a lot more longer dated treasuries. But I don't think now is the time to commit to that because of all the uncertainty. So I think just suggesting that there's still that uncertainty, I think we'll see it in the dot plot. If the long run dot comes down, it'll be the lowest ever long run dot. So I think that will be the Fed saying, well, maybe there is some impact on our star based on the 1914 pandemic. Unfortunately, we don't have too many pandemics to go to. But I think some, reflection of our star may be lower. Inflation, even though there's talk around high inflation for some necessities, I think to suggest that unlike a war, capacity is still out there. You look outside, there's still all that capacity. There's tremendous amount of slack in the system. I think for him to stress on that will actually tell the market that the Fed is likely to be accommodative for a long, long time.
Speaks to low inflation, speaks to low rates for a long, long time. Priya, I just wonder if they can make it even more simpler. Just a few months ago, if you asked the Federal Reserve what their objective was, it would be extending the cycle. Can they say something like, we need to get this economy back to pre-COVID-19 levels, that's the objective, and monetary policy will be loose until we get there?
I think they could. In fact, one form of strengthening forward guidance is to make it outcome-based. But I think if we realize that there could be a lot of structural damage done to the economy, I think it gets a little harder for them to commit to pre-COVID levels. Plus, remember, the economy is growing at a trend. So are we getting back to pre-COVID output level or are we getting back to pre-COVID trend level? I think they'd like to get to trend. But if there is a lot of structural damage done, if defaults start to pick up, I think the Fed will struggle to say we want to get back to that level, but to suggest that we're not about to take the foot off the pedal. In fact, we might accelerate more in terms of easing if we find that these risks that they're talking about. So I think today they really stress on the risk. If they do materialize as we reopen and we're not reopening to the old normal, then they actually come in with more. I think that's what we really need to see, particularly after the rate rise. I mean, last week we had a pretty significant rate rise. I think the market's trying to test the Fed to see how accommodative will they be, or are they okay with rates being higher? I think Chair Powell will be pretty forceful in that they don't want much higher rates here.
Priya Misra, when we talk about getting back to pre-COVID levels, we've already gotten there when it comes to markets in terms of reversing some of the losses with respect to the S&P and NASDAQ. There's a feeling in markets, heads I win, tails I win, because the Fed is going to come in and backstop asset prices. So far, the Fed has given no indication that they would like to push against that. Do you think that this impression that the market has is correct, that basically this is the one tool the Fed has and they're going to double down on it, and that is keeping asset prices high?
Right, great point. I mean, if you look at the stock market, you'd almost say, what pandemic, where is this medium-term risk being reflected? I think the stock market is partly reflecting the fact that the Fed has just told us that rates are going to be low for a very long period of time. So when you discount cash flows, that interest rate component is important. That's why PE multiples rise. I think what we are all struggling with, frankly, and I don't have an answer, nobody really knows, is what is the medium-term outlook? Has there been structural damage done? I think, the market is right in that interest rates are going to be low for a long time. I struggle with the E component of that, the PE. The PE could be higher, but if companies are, going bankrupt, or particularly small business is getting impacted and we don't do enough on the fiscal front, and this still worries me. I expect Chair Powell to make another push for more fiscal stimulus here. I don't think he'll bring up financial stability as a reason for them to cut back on accommodation, because if they do cut back on accommodation and you get a pretty big impact on the economy, or you worsen the recovery process, and that's really the worst case outcome. So I don't think they stress on financial stability, but I do think the stock market is pricing in this getting back to normal, and that's what really we struggle with as to what this new normal is.
Priya, we've got a hat trick of sophisticates here in the bond market. That would be you, Lisa Abramowitz, and the host of The Real Yield, John Farrow. For mere mortals like me, can you explain to me, is the Fed action that is talk, or is the Fed action that's actual tangible action? What part of where they are right now are they? Are they all talk and promise, or are they actually doing it right now?
So they've done a lot. I think we shouldn't forget how much they did in March. In fact, some of the facilities are still getting rolled out. So I would not discount the action part. They did take rates down to zero. They've been suggesting through talk, and forward guidance is a very powerful tool. I think the innovation of the 2008 crisis was forward guidance. The Fed discovered that if you tell the market that you're not hiking for a long time, that can keep rates low, that can help asset prices. So I think they continue to use that as a tool. That talk is powerful. They do have various ways they can talk: Fed speeches, press conference. The dot plot is one form of that communication as well. The action will be needed, though, at some point, particularly when you talk about the 10-year, because talk can only really anchor the front end. So I'll be certainly watching for how does Chair Powell frame the QE program? Is it just about market functioning? Because if that's the case, Treasury market's functioning just fine. They can stop QE here. I don't think that's the right policy. I think that's going to result in a big rise in rates. So the action will be needed. Now, the Fed every week does buy treasuries. I think they retain that flexibility to buy as much as they want, as much as is needed, as where on the curve. But I think we do want to hear some talk that's helpful for the long end as to how they're framing it. I think suggesting that we don't want longer term rates rising will tell us that the Fed will buy as much as needed to keep that long end anchored until we know that the economy can handle higher rates. So I wouldn't discount talk.
Priya, brilliant work, as always, and always enjoy catching up with you. TD Securities Head of Global Rate Strategy ahead of that Fed decision. Priya, send my best to the team, won't you? Tom, forward guidance. It's the big issue right now, and also the objective of monetary policy. I just want to touch on that because you and I discussed it yesterday. The idea that they can try and say this is just about market functioning, as you and I talked about, they've gone way, way beyond just market functioning. The market's functioning just fine. How do they pivot from that? What does the next phase of policy look like? They're the questions for today.
Well, this is very similar to the financial crisis, in that everybody was worried about the markets blowing up and hedge funds blowing up. But, markets function through all this, and markets are functioning now, clearly voting for some form of recovery. I don't know how the Fed dovetails with that, John. I would suggest they're going to remain calm and they're going to remain cautious today, even as they play with the dots.
I would agree with that, Tom Keene. A little bit later in the program, we'll be catching up with Neil Dutta of Renaissance Macro, more constructive on this economy through the downturn and into the reopening. Does the data support it? So far, the economic data does. That is coming up next with equity futures just about turning positive on the S&P 500. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. The OECD warns that the global economy will slump 6% this year because of the coronavirus. And if there's a second wave, output could fall 7.6%. The OECD also warned governments that withdrawing support for business and workers now could make the economic and social damage even worse. Secretary of State Mike Pompeo is blasting HSBC for backing China's move to impose new security legislation in Hong Kong. Pompeo accused the London-based bank of what he called China's coercive bully tactics against the UK. He said Beijing uses HSBC's business in China as political leverage. The bank isn't commenting. China's foreign ministry called Pompeo's remarks narrow-minded and ridiculous. China's position is that Hong Kong's affairs are solely its concern. President Trump is undermining Germany's Chancellor Angela Merkel, and it comes at a time when Merkel's facing growing pressure to get tough with Russia's Vladimir Putin. The president's decision to withdraw almost 10,000 troops from Germany was welcomed in Moscow. The US still hasn't officially notified Berlin of the withdrawal. The move would reduce the number of US troops in Germany by about 1/4. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week. I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
No, not the time to worry about inflation. Right now, you throw everything you got at the virus. You hit it, you kill it, you win the war against the virus. You throw everything in terms of finance, in terms of budget resources, in terms of health resources, because the sooner you beat the virus, the less expensive the recovery will be.
And how they threw everything at it in the last few months. That was Angel Gurria of the OECD from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramovich. This is Bloomberg Surveillance Live on Bloomberg TV and on Bloomberg Radio, getting you in shape for the market day ahead of us with a Fed decision on deck. Your market shaping up as follows. In the equity market, we advanced by 2 points on the S&P 500, up by around about 0.1%. Outside of that, the bid stays in. The bond market, Treasury yields coming down 3 basis points on a 10-year, just south of 80 basis points on a 10-year maturity in the Treasury market. Just a little bit of curve flattening, yields lower in the last 24 hours off the back of some real steepness and a push higher in Treasury yields over the last few weeks. Outside of that, in foreign exchange, just to get you up to speed on that weaker dollar story, weaker against everything in G10, with the euro advancing once again, Tom, with the Federal Reserve decision later this afternoon down in D.C.
Well, the Fed decision, absolutely, John. I want to mention that Angel Gurria was the most fired up I've ever seen him as we talked about his Mexico and Latin and South America absolutely crushed by the pandemic. It has been extremely difficult in South America, particularly Chile. Right now on the Fed, as John mentions, we need to speak to an optimist. Neil Dutta has had great acuity about being more optimistic about the American consumer, really, than anyone else we speak to. And he joins us now on this Fed Day. Neil, we had a great jobs report, a huge surprise. Clearly the vector there is better. We'll get claims tomorrow. Maybe that will show a continuing improvement from the horror that we're living through. Are we going to do the same dance with GDP? Are we going to underestimate the ability to recover? And are we going to hear that from the Fed today?
Well, I think yes and no. I mean, I do think the consensus is a little bit too negative at this point on, the second quarter growth numbers. I mean, as an example, you look at the Atlanta Fed as an example. I think it's like tracking minus 50% annualized for the second quarter. But we already know that in May, taking the input from the employment numbers, aggregate hours worked probably went up in May by about 65% at an annual rate, which means that, doing the math, I mean, it would take a lot to see that kind of number actually happen in the second quarter. So we're going to get a better number than what the consensus is currently estimating for Q2. I think the jobs number makes that clear, and we'll get more information on that as the weeks go by. But for the Fed, there's absolutely no reason whatsoever for them to sound upbeat. I mean, inflation is low. Risk management suggests you take a more of a cautious approach. You sort of err on the side of doing more. And so I think while we've seen some tentative signs of improvement, the Fed's not even close to declaring victory. And, I think what we're going to see today is, them sort of continuing to sort of signal that they're going to anchor the front end of the yield curve and keep rates low for a long while.
Neil, how comfortable do you think they are with what's happening further out in the curve on a 10-year, on the 30-year, just relative to where yields were several weeks ago? We've clearly had a repricing higher. Do you think they're comfortable with that?
I mean, I think so. First, I mean, if you look, I will say, Jonathan, I mean, if you look at the minutes, right, I mean, there doesn't seem to be much support on the committee, and this is a consensus-building institution, there doesn't seem much support for targeting interest rates 10 years out the curve. I mean, if you look at Bernanke's blog post on targeting interest rates, I mean, essentially they said that they were going to go, 2 to 3 years out. So, I think longer-term interest rates have picked up a little bit. I mean, and the reason they have is because growth expectations have picked up a little bit because the data's improved. So, it's not immediately clear to me that that's something they need to be concerned about. And of course, they're looking at broad financial conditions, right? And so, even as longer-term interest rates have picked up, we've seen the dollar has come in substantially. It almost looks like it's sort of back to where it was pre-crisis. If you look at your Bloomberg Dollar Index, sort of a broader measure, we know that high-yield CDX has come in quite a bit. Commercial paper spreads have normalized. So I think the Fed isn't just looking at longer-term interest rates, they're looking at broader financial conditions, and broader financial conditions, I think, at this point are conducive to growth again.
Neil, I want to talk about financial conditions because John and Tom were talking about this earlier. We've gone way beyond market dysfunction. At this point, it is the Fed propping up asset prices, keeping a lid on yields. How much is this the main driver of the rally that we're seeing in equities that is broadening out? And how much are traders counting on this behavior continuing of the Fed propping up asset prices in order to continue making bets on, say, the Russell 2000?
Well, I definitely think the Fed has your back, but we also know, monetary policy can't permanently inflate the level of asset prices. We talk about the equity markets and the economy and financial conditions. Obviously, there's a circular feedback loop between all of these things, right? So a strong economy means better financial conditions and so on and so forth. But if you look at when the market bottomed, at least equities, it basically coincided with a turn in the economy about 2 to 3 weeks later. Which is what you would expect to see, right? So, of course the economy is better than where it was when the markets bottomed. Just look at mortgage purchase applications today, Lisa. We're up double digits year over year. So purchase applications, a proxy for home buying demand, that's up 13% year over year. That's activity. We know more people are, we obviously see motor gasoline demand up. So certain industries are seeing very sharp recoveries, like housing. Other industries are not seeing sharp recoveries. But I do think that, that the economy is in a much, much better place. And, right now everyone's talking about these sort of second-order effects from, potential bleeding at state and local governments. And, but there are second-order effects from the momentum turn in the economy and the recovery in housing as well. I just think people need to keep that in mind. I do think that the recovery in the economy and the recovery in markets actually are frankly telling you the same thing.
And Neil, you've been brilliant over the last month, and we really appreciate your guidance. A more constructive view that has certainly paid dividends in this equity market and beyond. Neil Dudder there of Renaissance Macro. Tom Keene, we have had some positive surprises from a range of industries. We've had some guidance from Macy's. We've had some guidance from American Airlines. We've had some guidance from the retail wings of big Wall Street institutions suggesting that this reopening is delivering some positive upside surprises.
Right. Well, there's all these indicators. I'll give you one indicator, John, ensconced here as I am in the flight path of LaGuardia. I had one, I had two, I had 3 planes go by last night for the first time in ages landing in LaGuardia. That's a good sign.
I've got to say, plane watching might be your thing, Tom. Train spotting might be another thing. That's a big thing in the UK. I think that would suit you well. From New York City this morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and Radio.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with Lisa Abramowitz, 2 hours away from the opening bell this Wednesday morning. Good morning to you all. With equity futures turning just a little bit negative, basically unchanged, down a single point on the S&P 500 going into that opening bell. We hit pause on this equity market rally with the Federal Reserve decision just around the corner. In the bond market, the yield curve was steeper into the close on Friday. It flattens going into the Federal Reserve decision. 2s10s coming down to about 60 basis points. That's the spread between the 2-year and a 10-year. Your 10-year yield coming down 3 basis points in today's session to just south of 0.8% on a 10-year yield. Outside of that, one theme that does continue this morning and over the last month is a weaker dollar against the bulk of G10, all of G10 on the session. Euro advancing several tenths of 1%. That is a stronger euro, a weaker dollar going into that Fed decision. And J-Power news conference just around the corner, Tom.
Yeah, there's no question about it, John. I'm glad you mentioned euro. I was looking at that to go through 114. I don't know if it's going to get there. George Saravellos making very clear, John, at Deutsche Bank that he continues weaker dollar, maybe not that much strong euro, but definitely weaker dollar. He even framed out in one part of the conversation, John, a 120 euro. Can you imagine the challenges for Christine Lagarde with a 120 euro? I'm not saying he predicted that, but he framed out how you get there. Right now on this Fed Day, and we've got wonderful guests coming up, including Alan Blinder and our Fed show with Scarlet Fu. Look for that at 2 p.m. This afternoon. But right now is a most interesting economist. With his Iranian heritage, Mark Zandi has led the charge at Moody Analytics for years. He's out of the factory known as the University of Pennsylvania, and he wrote an incredibly prescient book 8 years ago called Paying the Price. Dr. Zandi, what's the price Chairman Powell is going to pay for the free lunch he's issued here? Down the road, there's got to be a price to pay. What is it?
Well, Tom, I don't. There's probably a price, but I think he has no choice but to go down the path that he's on. You know, the economy is flat on its back. The pandemic continues on. The risks are very high. I don't think he has any choice but to be very aggressive here and likely get even more aggressive.
Mark, I agree totally with your analysis there, but there's got to be a price to a 9 trillion or whatever the number is going to be expansion of what we got. How do you, I mean, you're at Moody's where you're linking economics into credit rating, et cetera. What is the price to pay of this multi-trillion-dollar expansion?
Well, I mean, two things. One, he made use of asset prices, markets, equity prices, credit spreads, real estate values, and that ultimately may be a problem down the road if markets get overvalued, and particularly if they turn speculative. It's something that central banks and the Fed are always watching out for. So that's a possibility. The other is, obviously he's enabling a massive amount of deficits and debt, and eventually that's going to be an issue. This is something that's happening across the globe. Every government on the planet is borrowing very heavily to battle this virus, and that there is going to be a price for that. We're going to have some kind of sovereign debt issue on the other side of the pandemic. So he's enabling that, but on the other hand, he has no choice, because if he doesn't, the global economy, the U.S. economy evaporates, and the deficits and debt are even larger. He has no choice. It's a Hobson's choice. There's no really good choice here.
Well, Mark, let me follow up on that, because that's a big shout, a big call, that we could have some sovereign debt issues in maybe several years' time. And I'm trying to work out from your perspective, you think that could happen in developed markets, or is that a problem for elsewhere?
I think that's a problem everywhere. in developed markets, Europe is, obviously most at risk, but I think every developed economy is going to struggle to some degree. And clearly, the emerging world is already under tremendous pressure and needs help sort of navigating through. So I think this is going to be a global problem, similar to the European debt crisis on the other side of the financial crisis. Once it becomes obvious to investors that the global economy has been diminished by the crisis and debt loads are a lot higher and the probability that they're not going to get paid in a timely way is greater, I think the same kind of dynamic is going to play out a year, 2, 3 down the road on the other side of this pandemic. And every country, including the United States, is going to be part of that event, that potential crisis.
Well, Mark, let's pin you down on that then. Define problem for us, because if you remind us of what happened in Europe, we're thinking about 6, 7% 10-year yields on Spain, on Italy. You're not saying the same could happen in the United States, are you?
No, the U.S. is still in the enviable position that it's, the best, it's still the AAA credit on the planet. It's still in the best spot of any economy, country in the world. So things go bad anywhere, money tends to come to the United States, flight to quality, and that'll continue. So no, I don't think that'll be the case. But I do think interest rates will rise to a point where it's going to put pressure. First of all, it's going to allow policymakers to connect the dots between deficits, debt, and the economy so that they have the political ability to do something about it. But I do think eventually the pressure on U.S. policymakers will be that they'll have to engage in some form of fiscal austerity, pull back on government spending, higher taxes, all of the above. So pressure will come on the United States, but not the kind of pressure that other countries have come under in the past, and certainly not to the degree that Europe did back, in 2011, 12, and 13.
Mark Zandi, as chief economist of Moody's Analytics, you take a look at the economic data, which is turning up, and it certainly is fueling this optimism that we're seeing being priced into risk assets. It seems as though the pandemic is over, at least in the eyes of many people. People are not accounting for necessarily a second wave or some sort of resurgence, even though a lot of health experts are expecting that. What would a material second wave do to both the economic statistics and the bleed through, the response to that in markets?
Yeah, that'd be a big problem. I think you're right. I don't think markets are attaching much of a probability on a serious second wave, and maybe they're right. We don't know. Who knows? But I think a prudent investor planner would probably attach a higher probability to that possibility. And if it's serious, what that means is it's disrupting businesses. Now, I don't think we're going to see government shut down businesses again. I think we've been there, done that. I just don't think there's the political will to do that. But that doesn't mean that businesses can't get disrupted because consumers will self-quarantine. They're already got one foot in the bunker. They'll run back in. They'll stop spending. The economy will be disrupted. And, that is the fodder for a double dip. So, I think we're out of recession now. We're going to grow in Q3 because businesses are reopening. But on the other side of this, we could go right back into the soup. And so this would be kind of a W-shaped economic period as opposed to a V-shaped, which markets seem to be anticipating. And so if that W does materialize, then obviously markets have some adjusting to do. The script on the bear market and equities and the narrowing in credit spreads that we've seen, all those things will come unwound, and markets will get tested again.
Well, Mark, I sound like a broken record today because this really is my big question. I do feel like today it's heads you win, tails you win. If the economic data deteriorates significantly, you get markets expecting that fiscal and monetary policymakers will just flood the zone. They will do whatever it takes, and they have more ammunition left. Why are they wrong?
I think they're misjudging the amount of ammunition the policymakers have. Central banks, still have policy space. They can still, Fed has room to maneuver, but other central banks don't, or at least not nearly as much. And governments are, borrowing very, very aggressively. And at some point, that is going to be a problem. They're not going to be able to go to that well so many times. So I think investors need to be cautious that policymakers can bail us out only so far. The other thing is, what may happen here if we go into the second wave, the thing that really would make it more lethal is that you see, a lot more bankruptcy, failure, default, foreclosure, repossession. I mean, so far we've avoided that. I mean, because of the policy response, I think we're going to see some of that coming, as the policy supports start to wear off. But so far it's been relatively minor. Prospects of erosion here are not overwhelming. But a second wave, going back into recession, I think those credit problems become very significant, very obvious. And for investors, they just won't be able to ignore it, and policymakers won't be able to offset it.
Hey, Mark, great to catch up with you. Really interesting thoughts. Mark Zandi there of Moody's Analytic. The more pessimistic view compared to the more constructive view that we got from Neil Dudder of Renaissance Macro, Tom, just 10 minutes or so ago. On the second wave, the aggregate numbers tell a constructive story. The disparity here in the United States, though, state by state, is getting a little bit more interesting, Tom. Just some caution coming out of states like Texas and states elsewhere.
And no question about it, and you've seen it in the last 2 days in the major newspapers, the parsing of the COVID virus in these states, and it's not going well. John, what I found there that's absolutely fascinating is Dr. Zandi, who is an optimistic guy. Let me make clear, folks, Mark Zandi is known, like Dutta, as an optimist, but Mark Zandi talking about a double dip like we saw in the early 1980s. The massive difference, John, is that was a time of money illusion, of massive inflation, of the good feeling of high interest rates. It's not there now. I don't know how you do a double dip in the United States if you don't call it Europe, or dare I say, if you don't call it Japan.
That'll be a theme for us later in the hour right here on Bloomberg Surveillance Live, on Bloomberg TV and on Bloomberg Radio. A little bit later on this program, we'll catch up with Ben Mandel of JP Morgan Asset Management on this market, which seems to be rallying much more on the good news than it sells off on the bad news. Right now in the equity market, we advance 3, call it 4 points on the S&P 500, up by around about 1/10%. In the bond market, the shape of things as follows for you. Over the last month, it has been about yields higher at the long end over the last few weeks, and a curve that's steepens just a little bit. Over the last few days, we reflatten and yields come in on a 10-year down 3 basis points to about 0.8%. On a 30-year yield, 1.55% in the United States of America. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Senate Republicans are drafting their own proposal for reforming police practices. It includes racial bias training, increased use of body cameras, and finally, enacting the first federal anti-lynching law. House Democrats have already come out with their proposals. They want to make it easier to sue and prosecute police accused of wrongdoing. All of this comes in response to the killing of George Floyd in Minneapolis. US authorities are investigating a vast hacker-for-hire scheme traced to India. It involves attempts to steal confidential communications from investigative journalists, short sellers, and advocacy groups fighting climate change. It's unclear who funded the hacking operations, but one of the beneficiaries apparently was the embattled German tech firm Wirecard. The company says it hasn't been in touch with any hacker group. A trade group for independent U.S. restaurants say its proposal for a $120 billion stabilization fund would pay for itself, according to the Independent Restaurant Coalition. The fund could generate more than $270 billion in economic activity. The Republican-controlled Senate already has signaled that the next fiscal response to the coronavirus crisis will be more limited. And call it a sign of the times, the Paramount Network has cancelled the long-running TV program Cops. The reality show that glorified police work was entering its 33rd season. Cops ran on Fox for 25 years before the network dropped the program. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
to slow down the pace to about 100 billion a month, coming down from 2 trillion in 1 month, because the markets have started to do their bidding. The markets have done their job by normalizing, and the liquidity they've added has really fixed all the liquidity in the system.
Bruce Richards there of Marathon Asset Management on the Federal Reserve's Herculean effort over the last several months. The pace of Treasury buying quite clearly rolling up in the last several weeks. What will they say a little bit later? The Fed decision very much in focus from New York City this morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. We're live on Bloomberg TV and on Bloomberg Radio in your equity market this Wednesday morning. Just a little bit of a defensive posture captured by an equity market that is just about positive on the S&P 500, but your outperformance comes from the NASDAQ. You know the story. You've become familiar with it over the last several months. In the bond market, treasuries are bid, yields are lower going into this Fed decision later. Your 10-year yield comes down 2 or 3 basis points to around about 0.8%. But in foreign exchange, it's as you were. Take a growth currency, a big growth proxy like the Aussie dollar, 8-day winning streak, 8 days of strength on the Aussie into Monday. We took a break Tuesday, but it resumes again this Wednesday, Tom. That's a weaker dollar and a stronger Aussie, top of the pile in G10 this Wednesday morning.
First chart I looked at this morning, John, you nailed it. Aussie yen, which is one proxy. You can look at a number of them, Aussie renminbi, but it's really amazing to see that idea. Talking to Jeff Curry earlier with Goldman Sachs, he made very, very clear he's still long gold big time, and also mentioned a commodity renaissance there as well. We've been talking with lots of good, smart people on this Fed Day. Ragarajan of the Booth School will join us here in a bit. Alan Blinder at 2 p.m. We talked to the giant of imperfect knowledge economics, Roman Friedman, an hour or two ago. Guess what? They don't matter. What matters is what to do with your money. And Benjamin Mendel of JP Morgan Asset Management is going to tell us right now, because he is focused on the international markets. Ben Mendel, we've seen a great, great tech move, as Jonathan Ferro mentions. Great. When do we get the shift to a true renaissance for international growth stocks?
Well, I mean, international diversification may finally have its day here. We've been saying that for some time, and the argument has been threefold. One is that valuations in equity markets outside the U.S. are more compelling, in part because they underperformed the U.S. market for several years here, and two, the dollar is expensive, as you're mentioning, and that's poised to at some point in the long term go back to levels consistent with PPP. I think the problem with saying that in late cycle, as we were up until very recently, is that that's a tough argument, because as you roll into the recession, U.S. equities tend to outperform, and the dollar just gets stronger. And so what's happened over the last few months is that you're operating with a bit more of a clean slate vis-a-vis those late cycle valuations and the dollar, and I think you're starting to see that now. It's not obvious that the dollar moves back to its long run fair value soon, but I think the direction is clear in an environment where you've kind of growth is picking up. You're in early cycle, and you're seeing that kind of washout having happened.
Well, we've got to distinguish, of course, Ben, between whether the dollar weakness that we've seen recently is a symptom of the improving risk appetite or a driver of it. And I think a lot of people would say the former and not the latter. What would you be your call, Ben?
We tend to think about the dollar in terms of relative growth, relative policy, and maybe the synchronization of growth. So there's definitely a sense in which everyone bouncing off of their growth lows in April is consistent with a dollar weakening in the short run. I guess the other thing is policy, and we'll see from the Fed today. I don't think anyone's as credible at pinning down short rates for as long as they're able to than the Fed, and so. I think that's part of it. But the risk rally, to your point, I think has to become a little bit more differentiated here. I don't think it'll simply be the case that all the early cycle winners will continue winning. So banks, value, cyclicals, you kind of have to pick your winners here. We like Europe and we like emerging markets. And the story with Europe, I think, will be reflected in part in the currency as well, where part of it is that they're will not be able to outmatch the Fed's ability in terms of forward guidance.
Ben, let's build on the Europe call, because I was looking today at the OECD projections that came out this morning for the economic downturn, and it looks like the European economies will be the hardest hit, in particular Italy, the United Kingdom, and France. But in the past month, Ben, to your point, you have seen European stocks outperform. What's being priced in, and what would be necessary both in the data as well as the stimulus front to keep this rally going?
Well, there's an inevitable V-shape in the data coming off of the month or two that we've just had. And so the fact is, economies globally, labor markets globally, and corporate profits globally, importantly, are still in a state of repair here, and we expect that to be brisk over the next few months. So Europe is no exception there. I think the other aspect of it is banks. So banks are a relatively bigger contributor to the equity index in Europe, and an environment where the unemployment rate is falling is a good one for banks, and we'd expect that to be relatively well supported there as well. So I think it's sort of a combination of factors. But there's kind of a subtlety in the economic aspect, not just in Europe, but in the U.S. as well, which is that governments have been very good at socializing the losses on the part of households, and so they've kind of filled up that hole in income. In the case of the U.S., even more so than the size of the hole itself. I think on the corporate profit side, that's impossible to do completely, and the incidence of losses, so the distribution of those corporate profit losses across the operators, the banks, the landlords, and others is still very much up in the air right now, and the economic outlook is some complex function of that distribution of losses. And so I think, we like Europe here. I think it's important to kind of differentiate across the different regions, in part to hedge against the risk coming from that source of drag on the outlook from corporate losses.
Hey, Ben, great to catch up with you. Ben Mandel there of JP Morgan. I like Europe. Tom, how many times have we heard that over the last several weeks? I like Europe. I like Europe too, but for very different reasons. You've been burnt so many times if you've been buying Europe over the United States over the last several years. Yeah. Why does it change coming out of this pandemic?
And Ben Laidler, who's been dead on this market, John, Ben Laidler re-emphasized today the European banks. I mean, somebody who's been as good as Ben Laidler at Tower Hudson says, buy those European banks.
He's not alone. He's not alone, that's for sure. More still to come on Bloomberg Surveillance. Later in the next hour, the former RBI Governor Raghuram Rajan on this program live on Bloomberg TV and Bloomberg Radio. With equity futures positive 6, call it 5 on the S&P 500. We're up by 0.2%. From New York, this is Bloomberg.
Chances are you may have started cooking more during quarantine, which means you've made plenty of trips to the grocery store, either in person or virtually. But brace yourselves, that chicken wing and hamburger patty, it's about to cost you more money. Just 4 meat processing plants account for about 80% of production in the United States. Back in April, President Donald Trump ordered all meat processing plants stay open.
They're going to be very careful. They are. As to who's going into the plant, the quarantine is going to be very strong.
Even as workers fall ill and production output suffers. So where are plant operators in all this? They have to go through lower productivity and higher costs, which means they need to make some major changes. And some plants are already running slower because of social distancing and fewer workers, and some production lines are fully automated. Tetro Das is a professor at the New Jersey Institute of Technology. He gives us the numbers. He says reducing meat processing plants to a third of their capacity and also distributing the adequate protective equipment, this could all boost chicken prices at grocery stores by 25 to 30%. That means if you buy chicken at 99 cents per pound for 5 pounds, now at $5.95, it could cost you up to $6.44 before taxes. That means higher costs for an industry that's been pretty efficient at putting out cheap protein.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market. Averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange. China's slumping onshore bond market is great.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
It's hard to imagine that we'd see a quick V-shaped recovery. I think it's going to be slow.
I think the data that we have in hand on the economic front do suggest a cyclical upturn in the third quarter.
Central banks, they did what they had to do, which is they're not trying to make life nice for the government.
The choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On this Fed Day, it is Bloomberg Surveillance. We welcome all of you on Bloomberg Radio across this nation and worldwide, all of you working at home, and on Bloomberg Television as well. Thrilled that you're with us for good conversation forward to this important statement by Jay Powell, an update on how the Fed can help America. The backdrop here this morning is wonderful. Markets up. I'll talk to John Farrow about that in a moment. But what is so important is you need to be advised. Robert Miller will join us with BlackRock in a moment, and we are thrilled to bring you Raghu Rajan of the Booth School Chicago. He will join us at the bottom of the hour for a must-listen interview. John Farrow, against everything I see, what matters is yesterday, and reaffirmed just in the last 60 minutes this up for the stock market.
But a defensive tilt to it, Tom, with the outperformance coming off the back of the NASDAQ, with NASDAQ futures up by around about 0.8%. I didn't think we'd see a day like we saw in the last 24 hours, Tom, where you could have a down market and still see the likes of Apple, Amazon and Facebook up about 3%. That's the regime we're in. They are the defensive names now in 2020, Tom.
And what's so important there, John, Apple with rumors, speculation of product announcements through this year. And again, one of those signals, folks, of corporate America where life goes on. Lisa Abramowitz, you're going to be looking at the Fed today through the prism of what, 6, 7, 8, I've lost count, trillions of dollars of debt buildup. What will you listen for from Chairman Powell as Mike McKee listens to that press conference?
the focus right now very much on yield curve control. How much does the Fed want to backstop yields where they are? And I will say, Tom, interesting to see equity futures rallying and actually building on gains as we see bond yields falling, particularly on the long end, the 30-year and the 10-year Treasury yields going lower. I wonder how much the action today is really baking in the support of the Federal Reserve, coming out and saying, we have your back with respect to asset prices until this economy gets going again.
Oh, let's get right to our guest right now. Bob Miller's with us, and what's great about this, folks, is I know Bob Miller has an entire bookshelf loaded with Fibonacci. He's read every Fibonacci there is, all 4,000. It's like Game of Thrones, folks. It's like 5,000 pages of Bob Miller reading Fibonacci. Bob Miller, you were at Bank of America. You've been running the ship at BlackRock, pushing a decade as well in multi-sector fixed income. Great. Have you ever seen this environment for fixed income? Is this new and the cliche, uncharted territory for the fixed income market?
Good morning, Tom. So it's interesting. It depends upon your time horizon, right? So in my career, we've entered a new regime, but we have in fact done this before in the United States, and we've done it in other countries. And what I mean by that is I would argue we've crossed the Rubicon with respect to fiscal monetary cooperation, and there's no elegant way to go back. So the Fed has effectively surrendered its balance sheet to Treasury. And will continue to do so in order to do its part in helping underwrite a recovery of economic activity to full employment and their target inflation regime. But we have done this in the U.S. before in the post-World War II period at a decade-long period of explicit yield curve control where the Fed effectively, again, surrendered its balance sheet to the fiscal agent. And I think that's the regime we're in for the foreseeable future.
Bob, what you just said is so powerful, and you said it so diplomatically. I'm trying to work out what that means for the longer end of the curve. We know they are very able. Their ability is unquestioned to anchor the front end. I'm just trying to understand what they can do with 10s and 30s and whether they formalize that effort, not necessarily today, but in the coming meetings. What are you expecting?
I don't expect clarity today. I don't expect an explicit yield curve target regime. I think they're implicitly targeting levels of yields that accomplish what we just described, right? That accomplish very accommodative domestic financial conditions in a way that support recovery of economic activity, specifically toward full employment. The 10-year rate, you mentioned 10s and 30s. 10-year rate's important to the mortgage market. So I don't think they're going to allow the term structure of rates to rise in a way that becomes disruptive to the probability of good recovery, of full recovery in unemployment. I think the very long end is tricky. It's harder to control. Frankly, it doesn't matter as much to the mortgage pricing. So I could definitely see some steepening, but I think that instead of trying to pick a level for each point on the curve, I think the more important part of the discussion is to appreciate that the Fed will do what is necessary. In our opinion, they will do what is necessary to encourage very accommodative domestic financial conditions for the foreseeable future. And if we end up in a situation where yields are rising for the right reason, because economic activity is recovering strongly, the trend in inflation is back toward 2 and or perhaps even above, the employment numbers are rapidly continuing to improve, just like we saw on Friday. If we're in that regime where a rise in yields is viewed as healthy and doesn't dampen financial conditions, which means equity risk premiums continue to come down, credit risk, then that's nirvana. That's the best outcome. If you're at the Fed, that's the outcome you're hoping for, because the alternatives are kind of grim.
But for a lot of people right now, they might be screaming at the TV, screaming at the radio wondering whether this is what the Fed should actually be doing or not. For programs like this, I think we spend far too much time on what the Fed should or should not be doing. Let's talk about what they are doing. That's what you're doing. If you have a price-insensitive buyer in your asset class, not just sovereigns, not just treasuries, but in credit too, can you talk to me about how the process has to change as an investor when you think about entering these markets and you consider valuations?
So, Jonathan, I think the most relevant, or one of the most important developments in fixed income in the past 3 months is the fact that if we're right about Treasury yields and they're going to be very low for the foreseeable future, the hedge effectiveness of Treasuries in your portfolio that has been a dominant factor for portfolio construction and asset allocation for decades, hedge effectiveness defined as the ability to produce a positive return in a risk-off environment has declined substantially, right? The Fed has effectively rendered the 5-year note at 38 basis points, with all due respect, kind of useless for my portfolios, the portfolios that we manage for our clients at BlackRock. As long as they're not going to embrace negative interest rates, which I do not think they will, or said differently, I think they're going to try everything else before they would attempt negative interest rate policy. There's just so minimal upside. Yes, treasuries are probably going to remain negatively correlated to equity prices. I get the correlation argument, but the beta or the sensitivity, the effectiveness of that hedge has declined. So the important thing for your question is if you no longer have that effective hedge in your portfolio or it's considerably less effective than it was before, you have to underwrite the other assets to their own absolute valuation. You can no longer depend upon buying somewhat expensive assets because you've got a really effective hedge in your portfolio as well. Now you have to own the assets at valuations that where they make sense on their own.
Bob, right now, if you take a look, for example, at high yield bonds, you can question whether the valuations make sense on their own. Is what you're saying that fixed income is losing its purpose? Why not just buy stocks and hold a portfolio of cash to offset any losses?
It's a great question. We lean in that direction, i.e., having more equity than rate exposure in portfolios now, as you've heard from my colleague Rick Reeder recently. That said, within the fixed income market, there are still pockets of opportunity, specifically in the places that the Fed is not dominating, right, where the Fed is not intervening and bringing their hammer of their ability to crush risk premium. So you've seen their activity in it's only now starting in investment grade credit, but investment grade credit higher quality has recovered substantially. But in securitized, for example, and in parts of the high yield market, there are still ample opportunities. There's still a real opportunity set for credit selection skill to generate alpha. So I'm quite constructive on opportunities in securitized, in CMBS, in CLO, et cetera, where the Fed is not influencing the overall risk premium in the asset class.
Hey, Bob, really important conversation and appreciate your time this morning. Our best to you, yours, and the whole of the team over at BlackRock. Bob Miller there on this bond market, and Lisa validating Tom Keen's cash position of the last 100 years. I want to get to this equity market and talk about the bankruptcy stocks, which have become an asset class of their own over the last week or so. Lisa Abramovich, just a little bit of news on Hertz.
Yeah, Hertz received a notice of delisting from the NYSE regulators, which is not that surprising considering the fact that the shares have gained almost 900% since filing for bankruptcy in late May. Why? Your guess is as good as mine, John.
I think everyone's trying to work that out. Hertz will continue to be traded on the NYSE pending resolution. That coming from the company. The stock down in the pre-market. I know some people have actually been trying to trade this. The stock is down by just 5.5% on Hertz. That has been incredibly volatile. More still to come on that story from New York City this morning. Good morning to you all. This is Bloomberg Surveillance, and we're live on Bloomberg TV and Bloomberg Radio.
With the First Word News, I'm Ritika Gupta. The OECD warns that the global economy will slump 6% this year because of the coronavirus. And if there's a second wave, output could fall 7.6%. The OECD also warned governments that withdrawing support for businesses and workers now could make the economic and social damage even worse. Secretary of State Mike Pompeo is blasting HSBC for backing China's move to impose new security legislation in Hong Kong. Pompeo accused the London-based bank of what he called China's coercive bully tactics against the UK. He said Beijing uses HSBC's business in China as political leverage. The bank isn't commenting. China's foreign ministry called Pompeo's remarks narrow-minded and ridiculous. China's position is that Hong Kong's affairs are solely its own concern. President Trump is undermining Germany's Chancellor Angela Merkel, and it comes at a time when Merkel's facing growing pressure to get tough with Russia's Vladimir Putin. The president's decision to withdraw almost 10,000 troops from Germany was welcomed in Moscow. The US still hasn't officially notified Berlin of the withdrawal. The move would reduce the number of US troops in Germany by about 1/4. And the US Navy is moving to ban public displays of the Confederate battle flag from its ships and bases. That's the military's latest response to growing calls to address racism. A spokesman says the ban is meant to uphold the Navy's core values. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
citizenry has more cash now than they had going into what will be the shortest recession in the history of the United States. This is not your garden variety recession. It's not because it's not your garden variety response, both on a fiscal and monetary standpoint.
Paul Tudor Jones to the Economic Club of New York in the last 24 hours. He added to that, if there was a franchise for humble pie, oh my Lord, that'd be a mile long to own that, because we all had huge gulps of it, me included. Some legendary investors in the past week, Tom, who just had to hold up their hands and say, we missed it.
No question about it. I'm glad you bring it up, John, and you really have to bring it up as you do gracefully with this is a tough, tough act, folks. I can't tell you the price of being wrong in the market when you don't participate, and that's why people like Paul Tudor Jones, Mr. Druckenmiller, and others, Mr. Marks, listen to the economists. One of them is Thomas Porcelli with RBC Capital Markets. He has been such a great help to us engaging this economy. Tom, I'm going to cut to the chase. What's the nuance? What's the distinction you're going to listen to from Chairman Powell today?
You know, I think in a lot of ways he sort of has preempted himself. Right? I mean, he speaks all the time. I mean, what is he speaking every day now? Sorry, that was a bad economist joke. So I think he talks with such regularity nowadays. Thank you for the late laugh. So I think he speaks with such regularity nowadays. I don't think that it.
We can start a segment again if you want. Tom, do you want to start again? We can just start it again. Take a breather. Just count to 3 and go again.
I think that there's almost nothing that he could say today that's going to surprise us. You know, the Fed is operating in real time. You know, they don't wait for an FOMC meeting to sort of to lay out a new program or to upsize a program like they did the other day with the Main Street facility, right? I mean, classically they would have waited until an FOMC meeting to sort of make that announcement, but instead they made the announcement yesterday or the day before.
Okay.
And so I think I don't look for anything that's all that revealing.
Okay. But brilliantly said, Tom, about every day is a Fed meeting, and I really think that really captures what we've been living for the last number of months. Then what does that say about the dumb dots? I mean, I have heard you say that dots are not efficacious. What are you going to learn from the dots today if every day is a Fed meeting?
Yeah, I don't think there's going to be much to learn from these dots, to be honest. Again, look, let's be clear. I mean, everyone that does what I do, we're in the business of trying to find something interesting or nuance and et cetera. And I have no doubt that, you know, even me later today when I'm writing my note on the Fed, I'll have to find some nuance. But I think at the end of the day, I think there's very little that we're going to even learn from the dots. I mean, I don't think that there's any question that the Fed does not want to adjust policy anytime soon. Now, again, surprise is relative. So what I would say is, I wouldn't be the least bit surprised if in the 2022 dots that you see some folks that are looking for a lift in funds. That wouldn't surprise me in the least. But I don't know if the market is totally braced for that. Now, again, I think as we all recognize, 2022 is an eternity from now. But I wouldn't be the least bit surprised if the Fed is basically acknowledging, which I think would be more than fair, that as you roll out the next year or two, that they're going to want to take back some accommodation.
Tom, you know why central bankers like forward guidance. Central bank heads love forward guidance because it binds the rest of the committee. It just forces them to shut up as the data improves to even consider raising interest rates. Do you think Chair Powell is that kind of leader that he'll be looking to bind the committee for the next 12 months, 24 months?
Oh, I don't think there's any question about that. In fact, I mean, look, the whole conversation on forward guidance is now sort of starting in earnest, right? And of course, at a minimum, we know that from the FOMC minutes. I mean, look, I think what we have to keep in mind